Seems like the renewable sector is going to be hit as a result of this spending and tax cut bill, if of course it gets to President Trump's desk. We've seen the outrage from Elon Musk around the subsidies for EVs that could be pulled forward in terms of the cut to those subsidies, possibly by September. So watch renewables. Chip stocks also in focus. There's an upgrade coming through from JP Morgan. They're saying there's going to be an inventory pull through in terms of what is happening with particularly with the memory and analog stocks. So a restocking in industrial chips that could give a lift to the semiconductor space. And Kering, there's an activist investor. We know Luca De Meo is going to be taking over as CEO, the owner of Gucci, of course, with all the travails. Active investor Parvus here in UK is taking a 5% stake, disclosing a 5% stake in Kering. So that is another stock to watch, Guy.
Okay, here we go. It's not expected to be the busiest of market opens this Monday morning. Maybe everybody's excited about what happens at, 1:30? Wimbledon kicks off down in southwest London. So the FTSE 100's got other things on its mind this morning. So it is going nowhere in a hurry. The Stock 600 is up by a staggering 0.2%. We'll look for the sector story around that in just a moment. Spain is out of the gates, up a little bit more, up by 0.3%. We're expecting similar numbers to be posted elsewhere by the CAC. There you go. CAC Iran's out of the gate, up by 0.3%. The DAX may take a little bit longer to get going this morning, but I don't think there's much news that will get it too excited first thing this Monday morning. So we'll wait and we'll watch. We'll see what European equities do. But the story at the moment is a slow start to a busy week, a week that really starts to ramp up as we work our way towards Thursday, which, remember, is effectively the end of the week for U.S. markets. Val, what does the sector story look like?
Look, just a few minutes into the opening trade, we're seeing tech stocks at the top of the basket. ST Micro up nearly 3%, one of the biggest gainers so far at the open. With the broader sectors, we have 18 in the green, only 2 in the red this morning. That's chemicals and energy.
In terms of what is coming through on the individual indexes now, we're still waiting for the DAX, of course, in Germany. The FTSE 100 up just 0.1% at 8,800. The CAC over in France up 0.2%. ST Micro was the stock that you called out, Val, of course, currently, as you said, up 3.3%. We did have that call coming through from JP Morgan around the semiconductor space and lifting their view on the inventory cycle, particularly around those industrial chips. On the downside, Guy, some pressure coming through for those energy companies. Then Ørsted, for example, the wind turbine maker, currently down 1.4%.
Yeah, we said the renewables were going to be under pressure. Vestas is down by 2.5%. Ørsted is down by 2.4%. So we are seeing some evidence that maybe what is happening in Washington is having an impact on this side of the Atlantic. So that's definitely worth paying attention to. We mentioned what is happening in the broader energy space. Not seeing much big reaction in terms of the major oil companies this morning. Shell is down by 0.2%. It is one of the biggest points drops, but nevertheless, on the upside, you do have tech and some of the pharma stocks doing well, though Rheinmetall's not doing too badly either. Rolls-Royce is up by 0.8%. And there's not other than the fact that maybe energy's a little off and renewables are definitely down, I don't think there's a clear theme emerging out of this morning's
defense stocks are also in the green this morning. We should note this in Krupp. I mean, a few of these defense names, some of the biggest gainers so far at the open, so that defense trade continues to roll on. It did give back some of it on Friday.
Okay, let's bring in Helen Jewell right now, CIO for Fundamental Equities EMEA at BlackRock. Helen, always great to get your insights. I want to start on the US, given the records that came through for the S&P 500. Our team over at MLive, at least Van Ram at MLive, suggesting that the US equity market is dislocated from some of the fundamentals in terms of the slowing economy, in terms of the potential tariff risk, that there is complacency right now in these US markets. There has to be this Goldilocks scenario that unfolds for US equities to have a further run to the upside. Do you agree with that view? Is it complacent right right now to think that you should be getting further exposure to US stocks?
Yeah, no, I think it's a really interesting point and great to be here to talk about it. I don't think it is complacent. I think that everyone looks at that index level, and record highs, given what we've seen go on this year, does feel a little bit unusual, but there's a couple of really important points. The first is that within portfolios, you are actually seeing quite defensive positioning in portfolios. So yes, there is exposure to the US, and people are thinking about adding back there. But on the other side, you also have gold still doing very well. Those defensive names, as Val said, also doing very well. So portfolios remain incredibly balanced, even if the US is reaching highs. The second part is, and it always comes back to this, the earnings are continuing to deliver. The AI theme in particular is really, really doing well in the US. All of those companies continuing to commit. And actually what we're seeing is that there is a real commitment from the US, given what they want to do and make sure that they are, going back to January in Deep Sea, not being overtaken by China. That commitment remains, that drives through to earnings, and that is one of the key things that is driving that US market at the moment. The resilience of the companies, the returns of the companies, and the growth of the companies in the index.
And on earnings expectations, how much assumption is being made around Fed cuts then, being priced into those assumptions as we project out towards the end of the second half?
There's certainly some element of an expectation of a Fed cut, and the Fed has certainly become a lot more dovish in recent times. And there is that expectation that that would be a Goldilocks Fed cut rather than anything that is because of a real softening of the market. But it isn't totally reliant on that. If you think back again to these big, large companies, with the amount of cash that they're spilling out, with the CapEx commitments and actual spend that they are making, even if you don't see a Fed cut, which I think is unlikely, but even if you don't see one, I think those earnings expectations remain. The one thing that would be a risk is a real softening, a real slowdown in the jobs data, in the JOLTS data as well. These are things we do need to keep an eye on. Anything that shows that the US is tipping into recession is obviously not a good outcome. But anything else, actually the US and the US companies are showing their real resilience. And the other thing I would mention, don't forget the S&P is up 100% in the last 5 years. The cushion and the buffer that exists in markets and in the economy because of all the capital that is around at the moment is quite extraordinary. So I think that plays a big part. It's the retail investors who've been buying the dip. Let's not discount the impact that they have on the markets. And I think that's an important part at play here as well.
What is your view on this reallocation trade, the thought that global equities outside of the U.S. will outperform, for months, quarters to come due to investors diversifying away from U.S. assets? Because I was reading a report from Morgan Stanley saying they didn't find much evidence to support the narrative that foreign investments have been reallocating away from U.S. stocks. And then Bank of America's Michael Hartnett also said that U.S. stocks are on course for a third largest annual inflow ever. So there does seem to be a debate around this reallocation trade. Where do you stand?
Yeah, no, it's a really interesting one. And yeah, Michael's right that we are seeing a lot still going to the US. What's really interesting is that when it comes to US dollar investors in the US are continuing to allocate. US dollar investors outside the US, the Middle East investors, for example, they are certainly being much more diversified in how they're thinking about portfolios. So again, let's just think about the US investor versus the non-US dollar investor. The other thing that I think is so important for Europe's had a strong performance year to date, but it's almost exclusively driven by the defence names and by the banks' names. What we're starting to see, and you're seeing again this morning, is those quality cyclical names actually starting to perform pretty well. For example, semis in the last month has done well. Semis is now up about 8% year to date, which is about in line with the stocks. And a lot of that has come in the last couple of months. Now, if we see Section 899, obviously that has moved away. Yep. If we see tariffs get resolved, that comes next week, and some certainty around that. Those global cyclical names in Europe, which are not the ones that have performed well, it's been very much a domestic story in Europe. That could be the next leg of the European story. So I think that's what's going to be really important, is those cyclical names. You're seeing it this morning. You're seeing the semis performing well. If that continues, that is where the next leg of Europe could come from. But if we do see Europe growth slow, or any kind of nervousness, or Europe again not be able to navigate some of the political tension we see, that will be a reason again for people to pull back, I'm afraid to say.
What's your view on FX hedging in your portfolio? Are you hedging against further dollar downside?
Well, we don't generally hedge. I mean, some of the portfolios do look at hedging, but on the whole, we don't do any kind of hedging because it's just very, very difficult to take a view on exactly where that dollar will go. It's not what we do. We focus on the earnings. So unless there's extreme positioning, which we don't have in portfolios at the moment, on the whole, portfolios are pretty well balanced. We don't tend to do any FX hedging within the portfolios.
How much of a headwind is that, though, at the moment? The US market's up. The S&P's up 5% year to date, but down, if you're a euro investor, by 7.5%.
It's a really, for the European companies who are exporting, then obviously it has been an issue for them. But what's interesting is that it's not had the effect on the equity markets that you would think. So it's something that you keep saying, why aren't you seeing more of these dollar investors coming in when the returns are quite so extreme? For some reason, the impact of the dollar, the dollar depreciation, has not washed through in equities in the way that we think. And I don't know whether that's because there is so many other things going on that's not been the focus, or whether actually there's a view that there's going to be some kind of stabilization of the dollar, maybe as a result of the Fed rate cuts being the Goldilocks scenario rather than a recessionary scenario, and therefore that we will see the dollar stabilization. But we're not seeing it coming through in numbers.
How big a risk is there that equities just rip to the right in a really big way? That Trump gets his tax cuts and he gets rates down. The narrative is being shaped by him quite significantly at the moment, and that actually equity markets just take off on that scenario, and you have to chase it if you're a portfolio manager.
I mean, there is certainly a little bit of a FOMO trade going on at the moment. And the big thing, which is so really very, very difficult to work out exactly what this impact will be, is the amount of capital that is there. This buffer that exists of 5 years of very strong growth in the S&P, 20%, 20%, of all those years of quantitative easing, then of COVID, and the retail investors in the market. It's very difficult to say, okay, we sit here and say 24 times, 25 times the US feels really high. But what's to say that actually people aren't prepared to pay 26, 27 times if they continue to see that growth in that market? All markets, including Europe right now, look fairly valued. 14 times for Europe is not cheap. The UK is the only one that maybe is kind of on the cheaper side, but even that's not cheap anymore. There are no pockets which is cheap. So maybe what we have to start thinking about is, what is the right multiple that people are prepared to pay for that market? And the challenge with that guy, it's really difficult to work out because you can't look back over history. What do I think it is? I can see a situation where I can see, assuming we don't have a recession, I can see a situation where I'm sitting here a year from now saying 25 times is a new normal for that US market.
Wow. Okay. Helen, nice to see you. Thank you very much indeed.
Thank
Helen
you.
Jones, CEO for Fundamental Equities, EMEA, joining us from BlackRock. Call 6 looks like this morning. Let's take a look at what the numbers are. We are certainly seeing a positive bid back into equities at the moment in certain areas, but in other areas less so this morning. Look at that. LVMH, Ferrari, ASML now softening up a little bit. Schneider's softening up a little bit as well. Nestle's catching a bid. Novo's catching a bid. Is that a broadening of the market? Let's talk to Joe Easton and find out. What do you got?
Spot in the market today, Guy, really is the renewable energy share. So all of them coming down. Remember, we got this update over the weekend on the latest tax bill. The Senate kind of adjusting that and potentially meaning that some of the credits, some of the tax credits for the wind and also solar energy stocks would actually be cut off sooner than expected, potentially by 2027. That would be a worse outcome than the market had predicted. So we're seeing Vestas weak, down 4.5%. Ørsted also soft as well. We're down 2% on that one. Then EDP and Nordex as well. Nordex kind of more in the solar panels business, but all of them getting a hit on that latest news from the Senate update there. Then in terms of luxury, Kering in focus, news over the weekend of Parvus Asset Management taking a stake in the firm, around a 5% holding in the maker of Gucci. Now, we have seen Parvus previously take a stake in Novo Nordisk as well, and we saw a bit of upside in Novo on that one. And Kering coming up, it has had a bad run, of course, not enough fancy handbags being sold over at the company, and that stock has been on a bad run, but it is gaining a little bit today, a little boost for that one. Then in terms of one-on-one, that was over in telecoms. Now, they did cut their earnings view. However, they have been on a bad run already, so potentially some of that was factored in. They downgraded their EBITDA outlook. A lot of that was due to their tie-up with Vodafone, which hasn't been as profitable for the company as expected, and therefore a bit weak on that one. So we're down a little bit on those shares. Then we've got the chip stocks. I'm feeling pleased with myself for bringing these ones up in stocks to watch, because there is a JP Morgan note out on the two firms saying that potentially the worries about inventory have gone too far, and a lot of companies are going to be coming back in and buying up some industrial chips, particularly in the auto space, and therefore we are seeing Infineon gaining and also ST Micro, both of them up more than 2% today. They've got a positive catalyst watch on the stocks, which essentially means they think the stocks could go higher, in other words. Then finally, over in chemicals, we've got Croda. That one was actually down a lot more when I asked for that one to be added. It seems to have come up a bit, but nonetheless, it is down 0.7%. Croda, it's downgraded at Kepler Cheuvreux, which says the ingredient space is looking a bit weak. So all the ingredients that go into mostly food and also makeup, that kind of thing, anything that goes into that, these are the companies that supply the actual raw goods. So Croda is downgraded at Kepler, who thinks ingredients is a little bit weak. That one falling 0.7% in London this morning.
Okay, Joe Easton from my equity team, breaking down some of the key movers on the upside and downside today. Semis, nice call there, Joe. Thank you very much indeed. Coming up, after 6 months of geopolitical uncertainty and turbulent US policy making, some unexpected winners are emerging. We're going to discuss where investor optimism sits. That is next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
Monday morning, good morning. 17 minutes past the hour, 17 minutes into the equity market session. Europe's going nowhere in a hurry. this morning. As you can see, the headline index numbers not doing a great deal. Below the surface, there's a little bit of fun to be had, though. There's a few sectors that are definitely on the move, and one of those is the renewable sector, particularly wind and solar, definitely on the move. The latest version of the US Senate spending bill proposing phasing out tax credits for wind and solar projects significantly more aggressively than we originally anticipated. The new tweak would require projects to be completed by the end of 2027, while the initial version simply required projects to start construction by the end of 25 to get the full incentives. Joe Wirtz joins us now to talk us through all of this. This feels like a big change this morning.
It is a big change. I mean, major wind developers say these things take a couple of years, and they thought initially that they would have 4 years to or several years to get these projects going, and cutting that requirement back means a lot of them won't be able to get it done. So this is a big blow to major, U.S. developers, NextEra, things like that. So a couple sweeteners in the rest of this for some solar leasing companies, but the solar energy industry in the U.S. has really come out pretty strong against this.
Now the Senate hasn't released, they obviously haven't voted on a final version
That's
of
right.
this bill. Is this something, the energy subsidies, is that something that's currently at the top of the agenda of something that Republicans are willing to budge on in order to get extra votes?
Boy, it's hard to say. I mean, if you think that anything is downstream of what President Trump is talking about all the time, it certainly seems like this is something that, would be at the top of the list. I mean, Trump will not stop tweeting about the green energy scam and things like that. So if that's setting the pace, then I think it's something they're going to take seriously and will be near the top of the list.
Okay, Joe Wirtz, thank you very much.
Yeah, thank you.
Indeed, with some of the changes in this Senate bill, of course, if it gets and when it gets finalised, and the potential impact on those renewable stocks also. And of course, we're already seeing the impact in terms of the moves lower in the session today. European stocks, meanwhile, outperforming their US peers by the biggest margin on record in dollar terms during the first half, the most dramatic sign of how the region's markets are staging a comeback after more than a decade in the doldrums. Let's review where we stand and bring in Bloomberg's senior strategist, Michael Masika. Michael, just kind of look back then for us on that first half and whether or not the ingredients are still there for further upside for European equities and outperformance.
Well, are they still there? Yes, they are. Is the outperformance going to extend as much as it did in the first half? Maybe not. We're seeing like a return of appetite for the tech industry, for US tech, the US big tech, and obviously this is doing a catch up. We have a catch up, but at the same time, there's a lot of tailwinds for Europe. The rates are still much lower than the US. The spending of Germany is here to stay. Europe is spending money as well on infrastructure, on defense. So we're having all those things pushing the European markets. At the same time, you have a rebalance of exposure from the US to Europe because trillions of assets have moved to the US over the past 10 years. And now investors are thinking, maybe we should rebalance a bit our portfolios.
Are they thinking or doing? Because at the moment it feels like we're in the thinking phase with a little bit of doing. What does it take to get the doing to be a bigger part, particularly for US investors?
We got the doing, especially from the European investor perspective.
Yeah.
It has started. Obviously, it's a tiny amount compared to what's been going to the US over the past 10 years. But all forecasts are indicating that investors are doing it. Now, the people we talk to in Europe, whether they are from big US banks or European banks, they're telling us there's a huge appetite for European assets, something that they hadn't seen in a very, very long time. And that appetite is coming from US investors, coming from European investors that have sent a lot of money to the US, and it's coming from Asian investors as well. So there's a change. There is a change.
So the euro is on its longest streak of gains in 8 years. It's been up for 7 sessions, risen around 2% within that time frame. At what level in the euro does it start to become a real headwind for the European economy? We just had a guest on earlier last hour saying he doesn't see 130 as a problem for the European economy. Do you think most people agree with that sentiment?
It seems to be the case. Look, the euro has been an undervalued currency for a very long time, or the dollar has been an overvalued currency for a very long time too, depending which side you're on. But what we're seeing now is a rebalance. We're still very low. If you look at a very long period, like the last 20 years, we're still on a very low level on the euro. We're not any close to the average of before the GFC, for example. And same here. The investors we talk to, the strategists we talk to, they're not seeing 130 as a problem. The problem would probably come when it gets to 150, but we are very, very far away from it.
Okay, you now win, okay? I've heard 130, I've heard 140, I'm now hearing 150.
150.
Not a problem until we get to 150.
Well, you know, it will feed into earnings. You will have earning headwinds.
Yeah.
But if you look at the long period since the euro started, when the euro is up, this is a sign that there is appetite for European assets, and that's what matters at the end of the day. And yes, you may have earnings headwinds, but at the same time, all the large corporates are mostly hedged for these, and yeah, and it's a good thing for small caps because they are, you know, locally exposed, and a strong euro is better for imports and for all their costs that they have to, all the goods that they have to import from abroad.
So that investor appetite offsetting a more expensive currency for Europe at the moment.
Well, on markets,
and up until 150, up until 150.
Well, maybe not to 150, but you know,
about 140, 150. Yeah. Look, a guy has been painting a scenario, a risk factor for anyone going short, or at least allocating out of the US, which is you kind of get this period of incredible stimulus in terms of tax cuts, trade deals, and lower rates in the US that could stimulate a significant bull market stateside. Is that the kind of scenario that would challenge and redirect those flows? I'm just trying to get a sense of like how much conviction there is in terms of that allocation out of the US and into Europe, and at what point people start to get a little nervous about the prospects of a revived US.
So there is that risk. Now, this is a risk for the overall equity markets, like not just for the US or Europe. The risk that you have with all those tax cuts, with the Fed cutting rates, and with people piling again into US equities, which are already back to expensive level, is you get to a bubble type of situation. And that's the main risk for the market. And that will feed into like every single market in the world, because if we get a bubble and it bursts at some point, everyone will suffer. So now, when you look at it as on a broader picture, as an asset allocator, you think, okay, I have a very expensive market that is at risk of a bubble, and I have a much cheaper market that is benefiting from heavy investment from governments, low interest rates at the moment already, and the same type of earnings growth in 2026. So, I mean, so far, if you're allocating assets right now, you have to rebalance your portfolio.
But you have to. Isn't the danger in this scenario that you have to chase the US? Like you get a rip from 20 to 30 in the Nasdaq, which is what Harnet's saying. Michael Harnet over at BofA saying could be a right-hand side tail risk. You get the cocktail, the very nice tasting cocktail that potentially Trump could produce if he changes the Fed, gets changes at the Fed, he delivers on tax cuts. You get that kind of rip to the right, and you've got for US tech, and then you've got the translated earnings from a cheaper currency as well. So US tech could really benefit from from earnings coming back in if the dollar's at 130, 140, and dare I say at 150. Isn't that something that as an investor, you're going to have to chase? Even a European investor is going to have to pile into that. That's a FOMO that you cannot ignore.
And that's what we're seeing at the moment. That's the catch-up from the US equity markets over the past month is clearly a bit of a FOMO and catching up, because investors were like underweight. Yeah. They were less exposed than they hoped that they would need to be. And at the moment, there is a catch-up effect. But at the same time, those fears of bubble will also play out. And, you know, you chase, but not to the end. Yeah, exactly. Yeah. You don't want to get burned.
When does the music stop? Michael, great to see you. Thanks very much indeed for stopping by to see our senior strategist here at Bloomberg, Michael Masika. Coming up, the July the 9th deadline is approaching next week, of course. We're going to talk about what the state is of the current trade talks that we're watching around the world. That is up next. This is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade. We are 30 minutes into today's session. Across the benchmark, flat right now. Here in the UK, the FTSE 100 not doing much either, up just 4, close to 5 basis points. On a breakdown of your sectors, top of the list is real estate right now, up 0.7%. On the downside, autos down 0.9%. On a headline basis, then, this is a market still looking for direction. On the trade front, Canada says it is rescinding its digital services tax in anticipation of a comprehensive trade agreement with the US, as both countries work towards a deal by July 21st. That comes as the world, of course, gears up for President Trump's country-specific tariffs to resume on July the 9th, unless deals are done. It's a deadline that Trump doesn't think he will need to extend.
I don't think I'll need to, because I could. No big deal. It's like TikTok. I'm extending that, but no big deal.
Okay, for more, we are joined by Bloomberg's trade czar, Brendan Murray. Brendan, let's start with Canada. There's Japan in the mix, there's India as well, and those officials, at least from Japan, are on the ground still in Washington trying to move negotiations forward. Start with Canada and how significant it is that they've given up a tax that was meant to be implemented today.
Yeah, it's a pretty big deal because this has been a big problem for the Trump administration since his first term. Digital services taxes aren't usually thought of as things that you fight trade wars over, but this is the new frontier of trade wars. E-commerce, streaming, services that the U.S. exports a lot of, and countries like Canada and the European Union and the UK can target if they want to raise money the way Donald Trump is raising tariffs to raise money for the U.S. government. So this takes us into a whole new battlefield, if you like, to fight trade wars. There's a whole range of services that other countries could target from the U.S. and the digital services one, the social media platforms that operate in other countries is just one of those areas. So it's brought in a completely different element and taken trade wars to a whole new level.
The UK-US trade deal has come into force overnight on British cars. The tariffs are now at at 10%. What's the outlook for these other nations currently negotiating trade deals before the deadline?
Well, they're trying to get something similar to what the UK got. It's don't take my reciprocal rate to the sky-high level that it was going to go to. Japan's, for example, is going to go to 24%. That's going to be a huge problem for the Japanese economy that's already teetering on the edge of a recession. So other countries are trying to get something like the UK deal. It's essentially a win-lose arrangement. You are going to pay your exports to the U.S. are going to be subject to a higher tariff, and Trump wants you to lower yours. So it's a tough pill for a lot of countries to swallow, but they're just hoping it's not as bad as it could be come July 9th if they don't have any deal.
At the end of this process, how much higher are tariffs going to be than they were before? Even if these deals are done, we've got sectoral tariffs to throw in, you've got all kinds of other things in the mix as well. How much higher do we think aggregate tariffs are going to be?
So Donald Trump, before he came into office a second time, so say early January, the average U.S. applied tariff rate was something around 2 to 3%.
Right.
Bloomberg Economics has run the numbers on the various scenarios that we're going to get over the next couple of weeks, and that number is going to go anywhere between 15 and 25%. So it's a huge jump, and there's a lot of debate right now about whether that's going to be inflationary, whether it's going to hit goods in the short run or the longer run, and we have President Trump complaining about the Fed chairman. So it's really more of a slow burn that we've seen on particular products seeing their prices go up. Look at the cost of aluminum cans. Imagine how much consumer goods come in aluminum cans. The price of an aluminum can has gone up 8 or 9% in the past couple of months just since those tariffs were in effect. So I think we're going to see that debate heat up about whether in these tariffs, once they get solidified, and these are effectively tariff deals. These are not necessarily trade deals in the way we think of them over the long run. These are arrangements, term sheets that countries are handed that say, here's your tariff codified in writing. The UK's was 5 pages long, and this is what you're going to pay over the next foreseeable future. Whether they're enforceable and they'll jump to the next administration or not is a whole nother question.
Okay, best case scenario, 15% tax and 15% tariffs. Brendan Murray, thank you very much indeed. Our trades are on some of the movements, of course, on the trade picture and what to think about as we head up to July the 9th. And for further insight into where those trade negotiations stand, Bloomberg will be speaking to the US Treasury Secretary, Scott Bessent, of course. Do not miss that interview later today.
Okay, let's turn our attention to what is happening, not with kind of European-US relations, but with European-China relations, because Europe is increasingly looking east, and China's top diplomat kicking off a visit to Europe today. Foreign Minister Wang Yi's trip comes, of course, as Beijing seeks to improve ties with other trading partners. We're talking about non-US trading partners, as its relationship with the US becomes increasingly competitive. Ollie Crook joins us once again around the table. Okay, so what is on the agenda here?
Yeah.
What do the Chinese want? What do the Europeans want to get out of this?
So what the Chinese want to do is come around the world and say, basically, we are a stable, reliable trading partner. You know kind of what our deal is, generally speaking, and you can rely on us in a time when there is extreme erratic economic foreign policy behavior from the United States. That's the pitch that Wang Yi is going to make when he goes to Brussels, when he goes to Germany, when he goes to France over the next couple of days. That will be treated with a great deal of skepticism from all of the sort of European policymakers that I've spoken to. For the most part, there are some exceptions there. You have the Spanish, for example, who have been pushing actively for a more open relationship with China. That has found a lot of resistance elsewhere. You have people like the Germans who have an enormous trading relationship with the Chinese. But of course, the whole Chinese model was sort of taking the German model and then scaling it at a massive level. And so they are also aware of the sort of the risks that reside there. What they would like concretely to get from this is a deal, hopefully, on rare earth magnets, something that we didn't talk a great deal about until a couple of weeks ago, but is absolutely crucial in, for example, automotive exports. Those have been highly restricted by the Chinese in the wake of the dispute with the United States. The Europeans can't get their hands on it, so that is something they'd like to make forward progress on, particularly when all of the leaders, a number of the leaders from Europe, are expected to go to Beijing at the end of July.
Is he likely to find a receptive audience in Europe on this agenda?
So it's going to be a pretty tough crowd for him. He's going to meet with Kaja Kallas, the High Representative of the EU. And remember, this new European Commission that was voted on, I think it was June of last year, came into power in December. At the time, China was the big threat to the European economy. This was before Trump was elected. This was before we had this trade war and all this sort of thing. That the Europeans were very focused on implementing the Draghi report and making their economy more competitive, namely against a little bit the Inflation Reduction Act, but mainly against China. Now that whole conversation has evolved, but it has not gone away in their minds. And just to tie it back to the conversation you were just having with Brendan Murray, I think that what the Europeans were really hoping for was a Trump administration that could potentially coordinate a bit more with the Europeans against China on trade policy, something that would be kind of pushing on an open door for the Europeans who could get on the same page with the Trump administration. That hasn't really materialized, but we have heard people from the Trump administration, Scott Bessent, who have kind of activated, sort of advocated for that tack. Whether or not they will actually get there is a separate story, because right now we're in kind of free-for-all territory. Free-for-all territory. That's what you want to be. Ollie, great stuff. Thank you very much indeed. Bloomberg's Ollie Crook joining us through what is happening with the European-Chinese relationship, and you wonder how carefully Washington is going to watch this trip. Coming up, we're going to discuss the risk assessment report released by the European Banking Authority with its chair. Jose Manuel Camper is going to be joining us next. This is Bloomberg.
Villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings, for the world.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
41 minutes into the equity market session, Europe's going nowhere right now. As you can see, European equity markets aren't doing anything at all. I think we're waiting for the next catalyst. Where does it come from? Could it be political risk out of the UK, out of the United States? Could it be some of the data we're going to see this week out of the United States? Clearly, NFP, non-farm payrolls, are front and centre. There's a lot of things to be factored in right now. OK, pop quiz. What's the best performing sector so far in Europe this year? You'd think, judging by all the noise around it, that it would be the defence sector. It's actually the banking sector, by far and away the best performing sector thus far this year. It is up in aggregate by 29%. Year to date. Utilities are the best performing sector. And Europe's top banking regulator raising a few risks around that. Concerns that circles of risk are being created within the financial system. We'll come on to the details of that in just a moment. This after the EBA has published its risk report. The European Banking Authority's concerns come amid a rapidly growing market, which investors are basically looking potentially to take on risk from the banking portfolio, but they finance it with bank payments to make that happen. Anyway, as I say, we're going to come on to that detail in just a moment. Joining us now is the chairman of the European Banking Authority, Jose Manuel Campa. Good morning. Good morning. So you published your risk report. Okay, so I've got the European banking sector up by 29% year to date. Investors think this is the greatest sector in Europe right now. Are they right? Are there any risks out there that we should be worrying about? What have you flagged within this report that we need to be thinking about?
Well, we flagged above all that the sector is performing well in terms of return on equity, so over 10%. In terms of capital, is the highest capital ratio that's had over the decade, 16%. In terms of risks, we're concerned about the geopolitical evolution and the risks that they come through that. And also, as you mentioned, we also highlighted the fact that as we go through the non-bank financial intermediation sector, there are links in there that we don't know that we need to identify better to make sure that there's no potential hidden surprises there that might come back to the banking sector.
Okay, so this isn't a risk-free trade. Let's put it that way. Okay, so let's talk about the geopolitical risks. How do you see them potentially manifesting themselves in terms of the risks that the European banks face right now?
Yeah, the most direct channel that we see is mainly through the trade channel. I mean, there's been all this discussion about tariff wars. Obviously, we all know that Europe is a very open economy with lots of trade. So most of the impact that we see will be coming is not directly to the banks, but indirectly to the bank's clients, to the non-financial corporates that are active in the trading sectors. And those are the areas where we see more vulnerability. There are other potential areas in which risk may materialize, particularly in the cyber war. There's cyber concerns, operational resilience concerns. That's one area in which we're also focusing. I think those are the two primary areas.
Okay.
What are regulators thinking about maybe strategies to handle this ever-increasing pile of government debt? We know that fiscal spending, at least from Germany and other European nations, has been growing. Are you guys looking at strategies of making it easier for banks to hold government paper?
Well, we're not looking for strategies to making them easier to hold government paper. We're assessing them from the risk perspective. Government bonds already have a very preferential treatment from the prudential perspective. They basically have zero risk weight and capital.
Unlike the U.S. at the moment, right?
Exactly. Yeah. So we're assessing how they evolve over time. Traditionally, the concern in the European Union has been basically what we call the domestic bias, the fact that many European banks tend to hold a large share of their sovereign bond portfolios issued from the local government. And we think that diversification on that portfolio will be really good.
Okay, so diversification of bond holdings is something you guys are thinking about. There was a paper on the ECB's website on Thursday talking about the urgent need to channel retail savings back into European capital markets. They're talking about developing these European-sponsored saving products in order to help this excess savings help out the capital markets. Is that something that's on your mind at the moment?
Well, I think that's a general theme of Europe right now as we're trying to develop what's called the Savings and Investment Union, right? Part of that challenge is basically that we know there's a lot of banking intermediation in Europe. There's not that much capital market intermediation, and savers put most of their money in bank deposits, and that needs to be transferred into capital markets. And it's not the bank's deposits the natural way to channel that money into capital markets, particularly if you think about equity markets. So moving into other products like pension plans, or investment products, investment funds, things of that sort, I think it's a natural way to go.
On that question then, Jose Manuel, of the significant risk transfer, so basically a mechanism for banks to insure against defaults in loans and in the loan portfolio by selling some of these instruments that cover that as a potential protection to pension funds, to sovereign wealth funds. You flagged, and you touched on this at the beginning of the conversation, about the lack of clarity in terms of whether or not those same banks are actually funding and lending to the same organisations pension funds or sovereign wealth funds that are actually buying those credit facilities. So the linkages and the lack of clarity there. What is your best estimate of the number of banks and the amount of lending to those entities that are providing those SRTs?
Yeah, we have limited information, and that's why we flagged this as an area of concern to try to have more information. But basically, we do know that over 50% of the banks are using significant risk transfers. You know, they are selling some of these products to the markets, and the expectation from our survey is that 3/4 of the banks will continue to do that. They're telling us that they want to continue doing that. So that's a market that's been growing. It's basically over $1 trillion market, of which half of that is significant risk transfers, you know, 500 billion. Now, on the investor side, we do know that the banks are lending to the non-bank financial intermediaries, 10% of their assets, of their liabilities, because of their assets, because it's lending, 10%, you know. We do know who they're lending directly, so I can tell you that there's not a lot of direct link in the sense that, you know, a bank is selling a significant risk transfer product and at the same time is financing the buyer. That's not happening. But it could be another bank that's financing the buyer. Okay. And it could be that the links may come back to the banking sector indirectly, you know, and that's the area that we need to identify more. That's what we've been asking for, basically more transparency and more reporting information so that we can assess.
And an environment of a financial shock, what would that mean potentially? What is the potential risk around
that? Well, potentially you get a vicious circle by which, you know, a bank has sell protection to somebody that's being financed by another bank, so therefore it's a bank giving protection to another bank, so therefore it all remains within the banking
sector. Do you have the tools and mechanisms to be able to get that transparency and get those answers?
Not yet, and that's what we're pushing. Is by the way, it's a global problem. It's being evolved in the context of the Financial Stability Board as well, that has asked for transparency in this area. At the European level, we're working with ESMA and the European Systemic Risk Board to get more information.
Could we just have a quick conversation about banking M&A?
Sorry?
Banking M&A.
Yeah.
Why are we struggling with this so much? What is your view? You must see daily headlines coming out of Spain at the moment, coming out of Italy, coming out of plenty of countries, trying to get M&A done, cross-border M&A, national M&A even, we're struggling with down in Spain. Can the European economy progress from here unless this happens? Or why is it not happening? Are you frustrated it's not happening?
Well, it is beginning to happen. There's conversations and there's proposals out there, but it's not materializing. I think that we are frustrated. I say we are frustrated in two dimensions, if I might say. You know, the first dimension, the most important one, is that the logic of most of these M&As continues to be domestic. Yep. It's not a logic of a single European market in the European Union. That's something that for us is very important. We think that if we want to develop the single market, which is the key message that comes out of the big reports that last year we had from the led by the Draghi report, is how much we can benefit from having a really deep single market, not just in financial markets, but in every sector of the economy. Well, for banking sector, applies the same. So the fact that the logic is domestic in most of these deals is an area of frustration for us. We need to continue to work in deepening the banking union. The second potential area of frustration is the sensitivity, the high sensitivity there is not even just national, it's local issues that become very sensitive. And that part is something that we need to be able to facilitate. It's not just a thing about.
I think we can get past this.
I hope we can. Okay, but building a single market is the best way to go.
Okay, it is, I agree. But do you, at the moment, as you see the landscape at the moment, do you think we're going to get past this? Do you think we're going to get significant M&A?
Well, I think we have two very good components. One, we have already evidence. You know, we saw a deal recently in Portugal of cross-border M&A between a French bank buying a Portuguese bank, and that's going forward with no significant opposition. By the way, with a significant stake by the Portuguese government that's willing to sell in that deal. You know, that's one good aspect. The second aspect is what you said before at the beginning of our conversation, which is the equity performance of the banks has been good. The perception that the banks have a long-term future from the investor's point of view is good, and the fact that there should be, as a result of that, activity for restructuring of investment in the industry. I think that will help us push that forward.
Okay. Jose Manuel, thank you very much. Indeed. Jose Manuel Campa, Chairman, of course, of the European Banking Authority, the EBA. Okay, this week Bloomberg is live at the ECB Forum, talking of banks, on central banking in Sintra, of course, Portugal. Join us on Tuesday for a policy panel with the world's top central bankers. That is at 2:30 p.m. London time on July the 1st. That is one absolutely not to miss.
Let's turn back to politics, this time UK politics. The UK Prime Minister Keir Starmer is working to contain a rebellion within his Labour Party. This ahead of a vote Tuesday, we think, on his flagship welfare policy that has provoked widespread criticism within the party and called his leadership into doubt. After being forced to make yet another embarrassing U-turn last week on cuts to disability benefits, Starmer will be spending today trying to persuade skeptics in his party to back a revised package. For more on this, we're joined by Bloomberg's Joe Mays. Joe, has he got the votes at this point? How big a challenge does he currently face? And is his job really on the line?
Well, it looks like he does have the votes. It looks like the concessions that were made last week will be enough to pick off enough rebels such that he gets us through the Commons. I mean, recognise he does have a very large majority, 128. So it would require about 80 or more of his MPs to rebel for that to be in doubt. So we think he's done enough on that one. He still does have a challenge today to sell these reforms to as many of those rebels as possible, to try and bring that rebellion number down so that it's not too embarrassing. Because really what this is about is a challenge to his authority. You know, can you as Prime Minister continue with the same level of authority when you have so many of your backbenchers rebelling on, you know, key government legislation? And so that's why it's important for him to reduce that rebellion. Is he in danger? I mean, I don't think so in terms of existentially as Prime Minister, but perhaps this is how these things begin. This is how your authority begins to sap away through moments like this. And maybe in future, this will be seen as the beginning of something. But clearly, it's an uncomfortable time to be Keir Starmer.
Joe, do you think this is just going to end up heaping more pressure on Rachel Reeves? This fact that they now have, you know, not just the winter fuel payments roll back, now this on welfare spending, it's just really adding to her headache to, you know, attain those fiscal rules and, you know, most importantly, keep the gilt market in line.
Yeah, there's two things going on here. There's an economic headache for Rachel Reeves, which is that, as you say, she now has another shortfall that she'll have to fill at the autumn budget. We think that's likely to have to come through tax rises because we have this welfare concession, which means they have £3 billion less than they previously thought they did. We have the winter fuel reversal, where they're giving more winter fuel payments to pensioners. That'll cost more than £1 billion. So that's already, you know, £4.25 billion that she needs to make up at a time when she was already only narrowly meeting her fiscal rules. So she has very little room to play with here. And that's why we are in this realm of talking about tax rises. But then there's also the political challenge, which comes from having to, again, U-turn on a significant piece of fiscal policy. You know, having to do this often undermines your authority, credibility as Chancellor. I think Rachel Reeves will be aware of that. And indeed, there's a growing conversation among some parts of the Labour Party that maybe her position is in doubt because of these U-turns and because of the difficult situation the government finds itself in.
Joe, is it too far to start speculating and start thinking about who may be taking over from the Chancellor, Rachel Reeves, given the pressure that she's under? Or do we need to think more broadly about the political dimensions as this, of course, the clout that Keir Starmer, the Prime Minister, has starts to erode, as you say, and what that means politically in polling and in terms of how the different political parties are starting to align around this story?
I mean, the beginnings of that discussion are happening in the Labour Party in terms of might we be better off with a different Chancellor. I mean, you look at internal Labour polling of their members, who's the most unpopular cabinet minister? It's Rachel Reeves. And indeed, with the public, the most unpopular cabinet minister is Rachel Reeves. Now, it's a long way until another general election, right? Or at least, you know, kind of 4 years away. So you can tolerate for the time being having an unpopular Chancellor. We're not at the point where that matters too much. But you feel like you can't drag on for too long. It becomes very uncomfortable for a governing party to have such a major figure who is so, well, he's beginning to be so unpopular. So it's a risky time, I think, for Rachel Reeves. She has time, but it could go south from here, and that's why there is that discussion beginning about potential replacements.
Joe, thanks for updating us. We'll look forward to the vote and the reporting around it. Great stuff. Joe Mays joining us on the UK political scene. OK, that's it. Monday, we've kicked it off. We are starting. We are up and running. We've got an awful lot else we need to think about as we work our way through this week. So non-farm payrolls is basically what it feels like we're moving up to. But the US political scene as well. Massive. Can get this over the line in terms of the big, beautiful bill in the Senate? Looks like the big story throughout the rest of the day.
Yeah, and then you add in all those trade negotiations. We know that the Japanese trade delegation is staying in Washington. So is the India trade delegation, hoping to, in some way, have a breakthrough in these trade negotiations. It seems hasn't come yet for the Japanese.
You're also watching, or you're going to be tuning to Wimbledon, Val?
Starting today. That should be on the week ahead, shouldn't it?
Yeah, my wife's there. It's very annoying. Sent to call.
That's your key takeaway. She got sent to call. Well
Alcaraz, day one.
Yeah.
I don't know if I want to sit there in the sun with 90-degree heat, but hey.
I think she's a bit further back.
Yeah, okay.
She got the strawberries and cream.
I think she'll be absolutely fine. Yes, enjoy it. Anyway, that's it for the opening trade. The Pulse is up next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg. At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Canada backs down, dropping its digital services tax as it looks to restart trade talks with the U.S. Now, progress in trade negotiations adds to upbeat market sentiment that pushed U.S. stocks to a record high. And President Trump's $4.5 trillion tax cut bill now shifts to the Senate for a marathon voting session as the July 4th deadline looms. A reminder, that's on Friday. Now, also coming up a little bit later on in the program, we're joined by Jeff Curry, Carlyle's Chief Strategy Officer for Energy Pathways. That's at 9:30 a.m. UK time. Now, we look, of course, at the markets every 15 minutes. Now, U.S. futures really rising as there is a little bit of, progressed lifting sentiment. Now, U.S. equity futures is because of what we saw between the Trump administration, some of the key partners, really adding to some of that upbeat sentiment that pushed the S&P 500 to a fresh record high. So for the moment, you can see futures are gaining 0.3%. I'm looking at U.S. 10-year yield at 4.2514, and then, of course, we look at euro dollar 117.23. Now, the dollar actually resuming some of its decline, and again, this is U.S. Treasuries pretty much advancing. Brent crude 67.5, and then let's also look at the European markets map. Now, I will be speaking to some policymakers over the next 24 hours when I go to Sintra for, of course, the ECB forum. This is the picture for Germany's NRW June CPI rising some 1.8%. This is as we break down some of the Germany and we really look at North Westphalia, Saxony, June consumer pricing rising some 0.2% month on month. Look, a lot of the focus here in Europe is not only what's happening in Asia, but of course trade negotiations with the U.S. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Canada has withdrawn its digital services tax on technology companies such as Meta and Alphabet in a move to restart trade talks with the U.S. Now, earlier, President Trump said the U.S. holds all of the cards in negotiations.
Canada's been a very difficult country to deal with over the years. We hear Canada, we have a great relationship with the people of Canada, but it's been very difficult, and they put a charge, and they were a little bit early, we found out about it. So, and we have all the cards. We have every single one. We don't want to do anything bad, but they have, economically, we have such power over Canada.
Well, joining us now is Roz Matheson, our EMEA News Director. Roz, Canada dropping the digital services tax, will it move the dial?
Well, it does mean that trade talks can restart, and the goal here is to get to a deal by later in July, around July the 21st. And the digital tax was potentially holding things up, but also it was probably more a bargaining chip than anything else. I mean, this was a bill that was brought in by the previous Canadian administration. It wasn't Mark Carney's baby. He could actually give this away without giving too much away. And this does force the restart of the conversation with the US. So if Donald Trump was hoping to stymie the trade talks by holding this bill up, then Mark Carney's just blown right through that. It's interesting because in that clip, Donald Trump is talking about having all the cards. And of course, Canada, Canadian exports, 3/4 of them go to the US. So that is leverage. But equally, Canada is the biggest buyer of US goods. So there's a very, very intricate, complicated mutual trade relationship going on here that's going to be very, very complicated in terms of getting to a proper, deep trade negotiation versus some of the broad framework understandings that we've seen happen so far in this US administration. But it does seem that this was more a bargaining chip than anything else. It'd be interesting to see if Donald Trump now turns his attention to the digital services taxes that are in place around the world. For example, with the UK, does that come back to the fore in the conversation, or was it really just about how or whether to lean on Canada to get these talks moving?
And Ross, domestically, the focus is on President Trump's multi-trillion-dollar tax and spending bill. Where do we stand ahead of the deadline this Friday?
Well, that's right. So we're going into a pretty fraught period, what's known as the votorama expected Monday, which is many, many hours, possibly 12 hours of debate on the Senate floor. What the administration needs is some of these 8 senators are holding out over the line. It can only afford to lose 3, and they're quite a way apart, which is the challenge. Some senators wanting further spending cuts, some senators wanting more protection for things like Medicaid or a slower removal of some of the green credits that are due to roll off. And so there are quite differences in what each of these senators is looking for. So you can lose 3, but not any more than that. And if this bill gets amended, of course, it has to go back to the House again. And so getting it towards the July 4 deadline remains very complicated. There'll be a long debate and discussion in the Senate, likely starting later today, as I said, called the votorama. And the question is, at the end of that, where are we at? Do we have something that can progress? Does it have to go back to the House, or do they lose more senators than they can afford?
Roz, thank you so much. Terrific briefing, as always, from Roz Matheson, our Bloomberg EMEA News Director. Now, private credit has become one of the most talked about asset classes in the past year, of course, also as we watch negotiations in the U.S., but this comes as both institutional and high Net worth investors look for new ways to diversify their investment holdings. Now, a firm that was an early adopter of private credit is Oaktree Capital Management, an alternative asset manager with over $203 billion of assets under management. And we're joined by Armen Panosian, co-chief executive and head of the performing credit at Oaktree Capital Management. Armen, so good to see you, and so good to see you actually in London. There's really quite a lot to talk about. Where do you see, first of all, the best opportunities in the U.S. and Europe?
Both areas have some interesting opportunities, but Europe, I think, has probably shifted the most in terms of a positive forward trajectory in terms of the opportunity sets. First of all, in Europe, we did not see the same level of exuberance in aggressive capital structures and buying activities like you did see in the U.S. that were fueled by growth expectations. Second, from a legal perspective, Europe has a very strong backdrop in terms of creditor protections and a tighter community. And then third, Europe is now stimulating its economy by spending, especially in continental Europe, spending in terms of defense spending as well as its industrial backdrop. So we're seeing a broad-based increase in M&A activity in Europe and probably a little bit less so in the U.S. At this point.
Where do you see infrastructure and real estate opportunities in Europe? Is it country by country, or are there certain projects that look attractive?
So we're a bottoms-up investor, so I wouldn't say that there is a top-down view of which country we ought to invest in and which we shouldn't. I think the clearest opportunity is probably in Germany. Mainly because of the debt to GDP starting point for Germany. But right now, I think it's still early days for us to really pick our spots. We're just kind of watching carefully and from a project-by-project basis, deciding where we ought to invest or lend against.
So, Armen, what's the trigger point, actually, for you to deploy capital and invest heavily?
Well, we are ready to invest now. We have a tremendous amount of dry powder at Oaktree across all of our strategies, and we're ready for the right opportunities that are structured appropriately. We tend to like to invest more when there is a dislocation, and we don't see very much by way of dislocation anywhere right now. So we're going to proceed cautiously and looking for just kind of our steps as they present themselves, rather than make a big market call and push in all at one time.
When you look at the U.S., is the housing market turning there?
It doesn't appear to be turning. The pricing is holding steady, but the volumes are quite low. Okay. And so housing prices are being supported by a decline in volumes. For now, at least, it seems that banks, in terms of commercial real estate, are just kicking the can down the road. And so we're not even seeing a tremendous amount of dislocation, but for very specific office markets in the U.S., I think the regulatory environment supporting banks is quite conducive following the failure of Silicon Valley Bank. And so nobody wants to see another bank failure, and we're seeing that play through with some relaxed regulatory adjustment towards the banks.
I mean, I keep on, being asked why there's not more volatility in credit markets. And I'm not sure why that is. Is it, demand from life insurers? Is it something else? Or is it just, dodgy market dynamics at the moment?
Yeah, so it's a great question. I think from a very big picture perspective, there was a lot of stimulus dollars printed during COVID. Okay. And when that capital spun through the economy, it made its way into the hands of savers. Those are insurance companies, corporate treasuries, high net worth individuals, and others. And so those types of investors are quite broad-based, and we're seeing all of them demand credit. They're actually demanding equity as well. You see the U.S. equity markets at all-time highs again, and it just shows you that there's a tremendous amount of demand and liquidity for investment assets. Now, the reason credit in particular is attractive is because base rates are so high and spreads are at attractive levels. They're not super tight and they're not super wide, reflecting any sort of stressed scenario. But when you add the base rate plus the spread across both public and private credit, it's a very attractive total return, and I would say it will likely outpace equity returns over the medium term.
So that won't change the appetite for credit markets, and you could likely actually see more buyers or more investors coming into this space.
We do absolutely see it. In April, when we saw the credit spreads back up a little bit, they widened probably about 150 basis points when the tariff news came out. We saw a tremendous amount of inflow coming into both public and private credit at that time.
Armen, I mean, your firm also raised some $16 billion on some of the flagship special operations funds. What's the fundraising climate out there?
For credit, it's actually quite good. I would say, though, it's quite broad-based. It's both private and liquid credit that is of interest. Liquid in particular, I think is a great purchase right now, just again, with base rates being where they're at and the ability to get into a liquid opportunity and get fully invested immediately and earn somewhere in the high single digits coupon on a contractual basis. I think that's a very attractive proposition. As it compares to pre-COVID, you were getting sort of mid-teens for high yield, mid-single digits, excuse me, for high yield bonds, and now you're getting high single digits. And it's a great environment for that. I think on the private side, because private equity is quite slow to deploy and to return capital, I would say private market fundraising is a little bit more challenging than the liquid credit markets are.
And does that change as there's a bigger, I guess, understanding of where the economy is headed? Or is it something that is structural and will be here for quite some time?
I think it's here for quite some time. I think investors have come to appreciate the exposure to private markets, especially private credit, the stability in the cash flows, the stability in the marks, the stability in avoidance of defaults has made it a core allocation for many institutional and high net worth clients, and we're only seeing growth in that regard. I think to the extent that there's any sort of minor hiccup in private market fundraising really relates to a tightening of spreads that's occurred in private credit, and so a little bit of a tapping of the brakes, but I wouldn't say the flow has stopped. In fact, the flow continues to be quite strong. I would just say it's slightly reduced from where it was maybe 12 months ago.
And Armin, what does it mean for staffing? So are you hiring? Are you hiring in certain spaces? Does the UK, for example, look attractive?
We're always looking for strong talent across all of Oaktree strategies. And yes, the UK is a particular area where we are hiring for deployment both in the UK as well as into continental Europe. It is absolutely a growth area for us.
Why the UK?
Well, UK represents about 30 to 40% of deal flow in the private, especially the private credit markets across all of Europe. So it is a very large part of what we do at Oaktree across all of our strategies. We certainly have a large office in the UK, and building onto that office is preferable versus having a bunch of satellite offices. So the UK market is quite robust and most similar to the US in our opinion.
I mean, there seems to be quite a lot of software lending, right? This seems to be a really big focus for private credit. What's your view on that, and in general AI, and how the two play off each other?
So there is a lot of software lending. I would say that it's been a very significant area of leveraged buyout activity for the last 8, 9, 10 years. There's some very large private equity firms that are quite good in understanding software and executing a business plan that makes sense in software. Software is either the first or second highest concentration in the broadly syndicated loan market, which appears to be achieving sort of its limit on how big it could go. And as you see slightly more aggressive software LBO transactions, they are making their way into the private credit markets. And so there is probably a 25 to 35% allocation in terms of new deal flow that we are seeing in large software LBOs. I think in addition to that, you mentioned AI. AI is a very attractive investment area. Nobody's really talking about the societal issues around AI, but from an investment standpoint, there's a tremendous amount of spending that needs to happen in the entirety of the AI ecosystem, both in terms of hardware and software. And that's a very intoxicating feeling from an investment standpoint, where you say, I could pick my spots from a regional perspective, I could pick my spots from a hardware and software perspective, from a service perspective. And so it sort of opened up a brand new investment opportunity for private equity firms and growth equity shops, but also for private credit managers like us.
Armin, is there a danger that actually, because the money's chasing AI, then there could be some, big outstanding loans at risk in software companies?
Absolutely. I mean, in any industry that experiences a great boom, there is the opportunity for excesses as well. I think about the fiber optic boom in the late 90s and early 2000s, where initially fiber optic CapEx or build-outs were done based on contracted capacity. Eventually, that fell away, and capacity was built without contracts in place. The same is starting to happen in AI with data centers. So it is an area that we are watching. We're careful about not chasing that exuberance. So we're looking for appropriately structured loans with appropriately capitalized companies and owners.
So interesting. Armin, thank you so much for joining us. I hope you come back really soon. Here in the studio, Armin Panosian, co-chief executive and head of performing credit at Oaktree Capital Management. Now, coming up, the world's top central bankers gather in Portugal amid global uncertainty. We'll find out how they're navigating Trump's presidency. That's next, and this is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet. Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back, everyone. Now, the world's leading central bankers will meet to discuss monetary policy at the European Central Bank's retreat in Portugal this week. Now, they're likely to discuss inflation and growth as they navigate President Trump's presidency. Well, joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management, and Moritz Kramer, Chief Economist and Head of Research at LBBW Bank. So thank you both for joining us. Seema, give us an indication of how, concerning or what questions you would have on how central banks navigate volatility in the price of oil, because I haven't really discussed this together since last year when oil wasn't a problem.
Yeah, I guess it's interesting because we have been, as investors, we've been less concerned about the price of oil. Over the years, it's just become less and less concerning from an inflation perspective. And I think, but what the key question for me would be, and this really relates to tariffs as well, is that, how much emphasis are they putting on short-term inflations versus long-term inflations? I think that's a key discussion, because if you're looking out across the break-evens, of course, there's pressure at the front end, but the long end is really quite suppressive, has actually come down a bit. So I think getting that kind of understanding and seeing how central bankers are discussing that would be key.
Yeah, and Moritz, I know you spend a lot of time looking at, euro area inflation, which just seems to be going down quite nicely.
Yeah, it's going well, I think. And it's going pretty well in almost all countries. Some are a little bit above the target, some are below. But by and large, the ECB can be very content with what it has achieved. The core inflation rate is still a little high, that's true, but I would assume and predict that this is going to come down as well, to the extent that, first of all, we have the appreciation of the euro against the dollar, for example, but also you have a declining trend in terms of wage settlements. So the big settlements after the inflationary shock, they're fizzling out. So I would think the ECB is in a pretty good spot, and Christine Lagarde can go relax to Sintra.
Yeah, I don't know about relaxing, given everything that's going on.
Well, compared to Jay Powell, anyway.
Compared to Jay Powell. Can the ECB cut one more time? Because I guess, to have interest rates below 2%, it feels like the economy should be in a really bad place.
Yeah, I would think they're going to cut one more time, probably September-ish. But really doesn't make a big difference whether they cut one more time or not. And you're right, if you have the policy rate below the inflation target, that signals sort of some concern. I think they want to reserve judgment until we really know where all these trade deals are going. And so far, the visibility is poor, so I think they wait this out and see where things are going.
Seema, where do you see, I mean, again, you know, Moritz is right, Jay Powell can't really relax on a number of fronts. It's like his independence being attacked, markets move just on speculation that there's some kind of shadow, you know, Fed chair being appointed in September. Like, what's his biggest juggling act? Will he just push back and say he's not moving until inflation does something?
Yeah, I think so. I mean, I think he has to ignore all of the noise. He's leaving next May, whatever happens. So it doesn't make any sense for him to try and get involved in a lot of the political saga that's going on around who's going to be the next chair. But I agree. I mean, they have such a dilemma at the moment. They've got the unemployment rate looking very suppressed at the moment, but with concerns it's going to increase. Maybe, maybe not. Same thing with inflation. Is it going to go higher or not? And then you've got a lot of, as you said, voices, but real concerns, again, where is neutral? So from my perspective, very similar to what it is for Lagarde, they need to wait until they have more policy clarity. At this kind of environment, when you have inflation above target, but potentially rising, and the economy is strong but potentially slowing, that is really ripe ground for a policy misstep. So the best thing they can do is really sit still and just wait to see how that data pans out.
Yeah, it's quite slow actually to transfer onto the data. A lot of the ugly surveys that we had after Liberation Day. Is it normal that it's taking that long, or is the economy behaving differently to what we could have expected?
Well, it's two things. So on the inflation front, I think it absolutely makes sense. It does take a couple of months, 2 to 3 months, before you see that inflation. I guess the price increase is feeding through to inflation. So we wouldn't anticipate to have had any kind of sign of it until maybe the next inflation print, or certainly into August is when we'd expect to see those numbers increasing. For the economy, though, I think the big learning for everyone has been just the resilience of the US economy. And when you go down to it, the balance sheets for households and corporates really does suggest that it's able to withstand a number of headwinds. So I think there's a couple of things to play. And then, of course, don't forget about immigration. The drop in labour supply is going to have a real impact on the way that we're going to be seeing what the payroll prints actually mean to the underlying economy.
Moritz, how do you look at the labour market in the US?
Well, the labor market remains tight. Obviously, the Fed has a potential dilemma, weakening labor market and increasing inflation. I would think the labor market's actually going to hold up stronger than some people expect, especially if you have extradition of maybe millions of undocumented migrants. But I would expect the Fed and Jay Powell specifically to be very cautious because if you're moving away from the target, both on the full employment target and the inflation target, you're just coming out of an inflation disaster, right? So we had inflation in sort of near double digits, and you don't want to do this 2 times in a decade, so you lose total control of your inflation target by sort of thinking, well, this may be transitory or not. So I agree with Seema. This has all the trappings of a policy mistake, and I think they learned from the first time round, and they're not going to do it.
So what does that mean? 1 cut this year,
none,
if anything?
None. I see none, no, because I don't really see the potential. If inflation is going up, why would you cut rates? And Donald Trump doesn't actually serve his purpose by sort of lambasting Jay Powell, because I think this will just increase the resistance, because the Fed has no appetite of appearing like the Central Bank of Turkey, who's doing the bidding of the president.
Do you see 1 cut?
I do. I see one, but very late December, if anything, pushing potentially into 2026. And the key thing is that if they were to cut rates before the end of the year, certainly July, September, then I think Trump's going to move into fairly dangerous territory, because the market is going to get concerned about what happens to inflation in the future. And you're going to see that upward pressure at the long end of the yield curve, which is the exact opposite of what he's hoping for.
How much should we worry about stagflation? And I know stagflation broadly means different thing to different people, but is this really what monetary policy should be watching out for?
Well, I think it's right that central bankers are going to be very careful. You know, as Moritz was saying, having come off the second, already one very significant inflation shock, they can't afford to have a second one, because then you really start to question credibility, inflation expectations becoming unanchored. In this situation, yeah, I think inflation is going to go higher. But again, I also don't think that the labour market is going to deteriorate too much. So potentially stagflation-like in terms of directions, but I don't think a major concern, just something that central bankers do need to be cautious of.
Moritz, is there a blind spot that they're not worrying about where they should be worrying more?
Well, I think it's not really blind, but I think markets are still a little bit blasé about public finances and the supply of treasuries. Now we're having the so-called one big beautiful bill sort of inching towards the finishing line. The White House denies that this would increase the supply. I think this is highly implausible. I'm definitely with the Congressional Budget Office on this one. And we're already starting from a totally unsustainable situation. You know, we're in peacetime, we have full employment and a 6% deficit quickly rising. This, at some point, something's going to crack. Whether this was going to be in a month, in a year, or in 5 years, I'm not able to tell. If I was, I wouldn't be sitting here probably today, and I wouldn't tell you. But something's got to give at some point, and either it's reform on the policy level, or the markets will react. And we know these are not slowly gradual reactions; they can snap.
Yeah, Moritz and Seema, thanks so much. Seema Shah, their Chief Global Strategist at Principal Asset Management. Moritz Kramer, Chief Economist and Head of Research at LBBW Bank. Coming up, we'll discuss the impact of Europe's defense spending push and explore the outlook for commodities with Carlyle's Jeff Kirby. That's next, and this is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, you know, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment. And it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Canada backs down, dropping its digital services tax as it looks to restart trade talks with the U.S. Progress in trade negotiations adds to upbeat market sentiment that pushed U.S. stocks to a record high. And President Trump's $4.5 trillion tax cut bill now shifts to the Senate for a marathon voting session as the July 4th Friday deadline looms. Now, on to defense, and Ukraine says Russia fired a record 537 missiles and drones in massive attacks over the weekend. Now, Kyiv claims that air defenses repelled 475 strikes, while Russia says all designated targets were hit in the large-scale strike. Let's bring in our Greg Sullivan. Greg, thank you for joining us on this Monday morning. What can you actually tell us about the strikes?
Well, as you said, this was the largest drone and missile attack in terms of number of ordnance that was fired since the start of the war. It also fits into a pattern that we've seen of an uptick in these strikes that have been happening in recent weeks, with Putin likely trying to put pressure on Ukraine amid ongoing talks to agree to certain hardline demands that he's made. Now, it's also important to note that this comes as the U.S. and Europe have been pressuring Moscow to agree to a ceasefire. The two sides have started talking for the first time since the early days of the war, and while they've exchanged prisoners, there's been little sign that they're making any progress, though, on any kind of ceasefire agreement.
So, meantime, Vladimir Putin also tightened his grip by expanding secrecy laws. What impact do those have, Greg?
That's right. It does look like he is taking advantage of the war and the war situation to try and tighten his grip on the control of information in Russia. Under this new decree, information about things like economic and trade policy, foreign policy, scientific development will all be considered classifiable, which basically just takes a whole swath of information out of play. Of course, Russia has been tightening their grip on information, their crackdown on dissent since the start of the war, and even before that. We've seen activists and journalists get hefty sentences, and of course other data is already classified, like some economic and budget data, and of course Russian casualties still remain classified.
Greg, thank you so much. Greg Sullivan there with the very latest on, of course, Russia and Ukraine. Now, the Italian shipbuilder Fincantieri planning to focus some Italian civil and military shipyards on just making warships. It's really the latest sign that Europe's defense spending bonanza is reshaping industrial strategy. Well, buyout group Carlyle says European defense investments could soar from current levels, and this could create a major opportunity for private capital. Well, I'm delighted to be joined by Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle. As always, thank you so much for joining us, Jeff. I'm excited because you talk about, commodities and oil so well, and now you're really going into the defense spending. Now, NATO members agreed to boost defense spending to around 5% in response to Trump, but also to Putin. Mm-hmm. Were you surprised by the pledge, and how do you see it impacting spending overall?
Actually, I don't think it's so much a surprise that it's happening. It's more like, why did it take so long? And I think a lot of it has to do with higher interest rates exposing the severity of the imbalances. And from a financial perspective, what we're witnessing right now is an unwind of the capital misallocations going back to 2008 and arguably all the way back to the fall of the Berlin Wall in 1989. And driving those misallocations, one was the GFC. The United States had the biggest stimulus, both monetary as well as fiscal, and it has all the plumbing to be able to accommodate that. And you can see that in, whether if it was in the banking sector, capital markets, all of it attracted that. The second factor was the Mag 7. And we're going to talk about defense in a second, but why doesn't Europe have a Mag 7? It had no military-industrial complex, because with that comes GPS, internet, AI, all of that are extensions of the military-industrial complex. And then the third one is we're unwinding the trade imbalances. What's the flip side of the trade imbalance? Capital inflows into the United States. And so what we're seeing is a rebalancing of global capital flows. And we think we're in the midst of a major capital rotation back towards Europe and towards the rest of the world that was going back to 2008.
I mean, your defense spending, prediction is massive. It's $14 trillion. Does the NATO spending actually help in making that a reality?
Well, 14, let me put this in perspective. The China boom, the BRICS boom in the 2000s was 10 trillion. Put it in today's dollars, like 15.8 trillion. So we're in that magnitude. Now, the 14 trillion is they do everything right.
Right.
The worst case scenario was 4 trillion, but even 4 trillion, that's a major capex boom cycle. And let's not forget, Europe really hasn't invested in defense going back for 75 years. So this is a big shift. And it's not, people, the macroeconomists say, oh, there's no cyclical benefit of defense spending. That's true from a demand perspective, but let's think about it from a supply perspective. I want to go back to, why doesn't Europe have a Silicon Valley? Why was Silicon Valley called Silicon Valley? The U.S. military needed chips to go in the B-70 bomber and the Minuteman missiles that didn't melt. So having a defense spending or a military industrial complex is a boom to productivity, technology. So there's a lot of side benefits. And one of the big benefits that we see at Carlyle is, why was VC created and private equity created? To actually allocate that capital from the U.S. military industrial complex. So this is huge. I like to say it's back to the future for private markets.
So does this change everything with Europe, but in what time frame? Because it takes time. If you have any industrial plan and then a defense plan, it's time and to also find the technology and find the right investments.
Right, and I think let's go back to the BRICS boom of the 2000s. It took a decade to allocate that capital. Once you built the infrastructure to allocate that capital, then you overkill it, and you'll overkill it here as well. But I think the key point is, this is not a flash in the pan. We're just beginning that process. And I've lived through 2 of these capital rotations. One in 2002-03, when the capital left the Silicon Valley and went into the BRICS, and then another one in 14 and 15 when it left BRICS and went into Silicon Valley. So we're on another one of these right now. So.
Yeah, and you've been coming on the show and saying, look, we've been underinvested in so many key parts of the economy, including energy and security in general. What role can private capital actually play in helping Europe develop its military?
Well, you need an industrial policy to be able to funnel this capital into the right place. You can't trust something like defense to the vagaries of the public markets, and you don't want to put it all in the hands of a bureaucrat. That in between, the happy medium is the private capital, because it's a way to be able to maintain some type of control, but to make sure that you still get the balances associated with market pressures. So, that's the reason why the U.S. relied so heavily on it.
But the question is will Europe be as open, right, to PEs and VCs that the U.S. was?
Yeah, because trying to allocate it directly, particularly with the regulatory framework in Europe, is going to be really difficult. Right. And so, like Airbus is kind of a Lego approach to, doing aerospace. And doing that on a larger scale within Europe, across borders and everything, private capital is going to be the most efficient way to make that allocation of capital.
Do you have any specific projects that you think will kickstart, if those go well, then it will attract even more investment?
I want to emphasize, Carlyle has a long history in aerospace and defense. We've done 45 deals within the aerospace and defense sector. At this point right now, is basically bringing in information, understanding what the space looks like. But Europe didn't completely get rid of its defense sectors. There's still a lot of mom and pop private held companies. Like France has a database that has over 1,000 companies that are dual purpose, commercial as well as defense. And so the opportunity in Europe is not as remote as I think people think. But I think it really starts with the private sector and these smaller type of companies that are more dual purpose.
We've also talked in the past about renewables. I mean, is it now, energy security that is the right word, but at the end of the day, will money and capital find the same deployment?
Yeah, energy security and, non-fossil fuels go hand in hand. I like to point out that France has the lowest carbon footprint of any industrialized nation in the world. And it did it in the 70s and 80s when it built all that nuclear capacity. And why did it build that nuclear capacity? Not because it wanted to save the climate, but rather because it wanted energy security. Another thing, take China. China has cutting-edge nuclear technology, solar, EVs. We know the list of what they can do. Why did they develop? They didn't develop it to save the climate. They did it for energy security reasons. And we think about fossil fuels. Why do we like them? They're portable and storable. But why are they dangerous? And as we witnessed with the potential shutdown of the Straits of Hormuz last week, it's because they're portable and storable. And the sun shines for everybody, the wind blows for everybody, and nuclear power is the size of your fist to power a city. You don't have that same risk that you have with fossil fuels. So I think the energy transition speeds up with this focus on security, doesn't slow down.
I mean, isn't it crazy, though, that we're just thinking of security, either energy or defense, in 2025? We should have seen it like 5, 6, 10 years ago.
Yeah, but again, it goes back to that point. What has really changed here I think a lot of it has to do with the 0% interest rate policies masked a lot of these imbalances. And now that interest rates are back up 4.5%, 5%, it starts to expose how serious these issues are and why they're hitting the burner today and they didn't do it 5-10 years ago.
Well, what do you think will happen in the Middle East? I know there's been talk about a possible regime change in Iran, which then would unlock a lot of barrels.
I think the existential threat of Israel and Iran definitely is receding right now. I think that. But I think an important point here is the U.S. didn't even blink over concerns about the Straits of Hormuz. And it had to do with the fact that they're energy independent now. And that's a critical change. Again, why are these things happening today and they didn't happen 5-10 years ago? 5 or 10 years ago, the U.S. would have been afraid to go into Iran because what if they did block the Straits of Hormuz? Now they're not dependent upon oil. And for Iran, you can't punch the guy that's hitting you if they don't feel any pain from it. And that's why the Straits of Hormuz weren't a issue for the U.S. and Iran didn't want to pull it. I think it goes to a broader point here. These energy security issues, the U.S. no longer has a concern to police global sea lanes to protect the oil trade because they're not dependent upon it anymore.
Yeah, but so what kind of, I mean, they still, if you think of the shale in the U.S., they need a certain level, otherwise it just doesn't work. Yeah. So does it balance, does it balance out if you go into strikes in Iran?
Well, I think the U.S. definitely needs prices above 65, 70, kind of basically where they are today. And you'll notice the administration went from 50 to 55, 60, and now it's 70. So they're kind of getting that message that you need to be in these levels. But I think people are very bearish because they believe there's this big surge of OPEC production. I want to emphasize, the 30 years I've been doing this, I've only seen 2 bear markets driven by supply. One in 14-15, another one in 1986. Producers don't shoot themselves in the foot, usually. And I think in this case, OPEC's going to be very data dependent, watch what's going on. And by the way, demand everywhere is surprising to the upside. In fact, I think we're on the position to see global synchronous growth for the first time in nearly a decade. Because you have the U.S. is actually looking much stronger right now. China's been surprising retail sales, exports, container traffic, and now Europe is releasing the debt brake on fiscal spending. We could actually see all three growing at the same time, and that kind of demand growth could accommodate that type of supply growth.
And this is against all expectations, is it?
Yeah.
I mean, despite the tariffs. So what's, is it structurally that the economy is so different than we thought it was, or is it that it actually just focused the minds of politicians and CEOs?
I think that when we look at the environment was when you're in a face with a high uncertainty, you do more spot, less term, meaning you're going to keep buying. And we saw this in 2018 when the last trade war, is that the hard data was very positive and the survey data was really negative. Survey data reflects how people feel. The hard data reflects what's actually happening. As they see the fear, they retract and go more to a spot basis, less on term, and you get that disparity. And as we saw, by the time you got into 19, that gap closed and the economy was doing well. Then COVID struck, obviously, but I think we're in a similar type of setup.
Jeff, I remember this iconic interview that you gave me like over 12 months ago. And you said, we're running out of everything and no one's realizing. And you were talking like copper, lithium, and everything, rare earths that we need to help with the energy transition. Is there now is investment back?
No, it's not. And I think you look at drilling in the U.S., it's off. Russia clearly hasn't been investing in oil. They've been fighting a war. Saudi Arabia is focused on Vision 2030. So there's 50% of the world's oil production. They're not focused on massive investment right now. And then you look at the rest of the world, they're not investing. By the time you get 26, 27, we have invested in refineries, drilling for oil capacity, and I don't want to get going on the other commodities. But I think when we look at the misallocation of capital, look at a ratio of equities to commodities or any financial market to commodities. You're just grinding lower and lower. This is going to reverse. I'm very confident in that view. Obviously, the timing, I think we go back to that view. It worked initially into 22 and early 23, but why did it stop? I think one of the reasons it stopped is the prices went too high, too quick, created a marginal increase in supply. Interest rates went up because of the inflationary pressures, and that slowed down particularly the property sector in China. And now we're rebalancing. That story we talked about in 21 and 20, it's still there. The question is what kind of demand growth will expose it? And maybe we see that this year.
There you go. We'll see. We'll follow it very closely. Jeff, as always, thank you so much for coming to see us.
Thanks for having me.
Jeff Curry, Chief Strategy Officer at Energy Pathways at Carlyle. Now, coming up, how European equities and the euro are outperforming as investors shift more money to the continent. We take stock on the final day of the first half of the year. That's next, and this is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Welcome back, everyone. Now, China's top diplomat kicks off a visit to Europe today. The foreign minister, Wang Yi's trip comes as Beijing seeks to improve ties with other trading partners, with its relationship with the U.S. remaining tense and increasingly competitive. Now, let's get more with Bloomberg's Oliver Crook. Ollie, A, I'm so happy you're in London. 2, there's a lot to talk about. So lay out this visit for us. What's actually on the agenda?
Yeah, so the Chinese foreign minister will be going to Brussels. He will be going to Germany. He'll be going to France for a number of high-level meetings with the foreign ministers, including the EU High Representative Kaja Kallas. And this is really part of the sort of Chinese charm offensive in the wake of the Trump administration going around the world and really saying, listen, we're a reliable partner. You know what you get with us. We're stable going forward. It's going to be kind of a tough audience, though, for him because those countries are ones that, for the most part, do feel the threat that China poses, its industrial strategy to the European Union. Even the Germans, who are a little bit sort of mixed on it, who have been sort of more positive about the Chinese relationship in the past, are a bit more resistant. What they need to get concretely from him is the question of rare earth metals and the magnets that we've been talking about that have been basically cut off by the Chinese in the dispute with the United States. Europe has also been affected, so concretely, that's what they'd like to make some progress on.
I mean, who are his friends?
His friends are in Spain and in Hungary. Spain is a bit in the doghouse after the NATO meeting last week, would not agree to spend that 5% target, really sort of upset. But overall, I think that for the most part, even the commission that came into power with the Draghi report as its sort of North Star, they're really cognizant of how much of a threat China poses going forward. There is also the hope potentially for the Europeans that eventually, potentially the Trump administration would want to get to a collective approach on trade with China, maybe bring the Europeans in, though at the moment, as you know, Francine, is sort of a free-for-all on trade, so probably not going to happen anytime soon.
It is a little bit of a free-for-all. Crook, in here all week? Until Wednesday.
Well, until Wednesday, yeah.
There you go. On Wednesday, on the Pulse, live from the studio, our very own Oliver Crook. Now, Europe. Let's focus on Europe, outperforming the U.S. in both stocks and currency, catching the attention of global investors. Some would say finally. It marks quite a comeback after more than a decade in the doldrums. So what's driving this shift and can it last? Well, we're now joined by Michael Msika, our senior strategist for EMEA Equity Markets, Macro Trends and Strategy. Michael, I mean, it's interesting to see finally the shift, a dramatic rebound for European markets.
Yes, this is something that's quite unusual, especially it's been lasting for quite a few months now. We're seeing a shift of assets from the US to Europe, not in a very, very big manner, but in a kind of a rebalancing portfolio thing. Europe is having a lot of tailwinds at the minute, lower interest rates, a lot of investments in infrastructure, defense. We're seeing the European Union coming together on stimulating the economy, driven by Germany and France especially, and that's getting traction everywhere. So people are talking about Europe, whether it's in the US or in Asia, and European investors are also bringing back some of the assets they invested in the US over the past 10 years.
So how significant is the currency?
It's very significant. But if you look at the long period since the creation of the euro, periods where the euro appreciated like that are usually periods where there is demand for European assets. So it's kind of a mark of confidence into Europe, into the European Union, and into European markets. So I'd say it's a positive.
And how has investor sentiment shifted in the US?
So the people we talk to, especially from large US banks, are all saying the same thing. There's a huge interest from US investors into Europe. The reason is they also need to kind of rebalance their portfolio now, which were very, very concentrated at the start of the year. We're talking the similar type of earning growth for next year between Europe and the US, slightly higher in the US, but at a much cheaper price in Europe. So probably less risks and cheaper price, same growth. People are rebalancing portfolios.
Michael, when you look at Europe, are there any industries that are really benefiting?
So obviously the defense is the main beneficiary, but infrastructure generally is what has been the interesting trend all over the world. Electrification, everything that's related to cables, to power, is something that investors are looking at. And obviously, what's financing all that? Banks. So banks have been the big driver of European performance over the past few years, and continue to do so.
Thank you so much, Michael Msika, there with the very latest, of course, in some of the European equities. Now to some other stories making news today, and Elon Musk has slammed the Senate's latest version of U.S. President Donald Trump's multi-trillion-dollar tax bill. Now, the Tesla CEO called the cuts to electric vehicle and other clean energy credits incredibly destructive. Musk said the bill would destroy millions of U.S. jobs and give handouts to industries of the past while severely damaging industries of the future. The U.S. president says he's found a buyer for TikTok's U.S. operations, but will not provide details for 2 weeks. Donald Trump told Fox News it was a group of very wealthy people, but the deal will need China's approval, and he expects President Xi Jinping to agree to it. Trump also said he would extend the deadline for ByteDance to sell its U.S. TikTok operations for a third time. And the UK Prime Minister is working to contain a rebellion within his Labour Party ahead of a key vote tomorrow on his flagship welfare policy. Well, Keir Starmer was forced to perform an embarrassing U-turn on plans to cut disability benefits last week. The vote comes a week ahead of the one-year anniversary of Starmer's election win. And temperatures across Western Europe are expected to be 10 degrees above the norm in coming days, with a heat wave brought by a blast of hotter air from North Africa. What's expected to stress power systems and has triggered health alerts. Joining us now is Joe Wirtz, Bloomberg's weather and climate reporter. So, Joe, thank you for joining us. These weather events are becoming increasingly more common. What does this mean for Europe?
Yeah, look, these early season heat waves, the ones that are coming in June, used to happen once every 50 years. New research shows they're coming once every 5 years. So it is raising heat stress across all systems. It's something people feel every day as they commute to work, as they get around the city. It's stressing power systems, increasing cooling demand. The heat wave that we're seeing now is bringing big cooling demand increases in the UK, France, Spain, At the same time, those rising temperatures are raising the temperature levels in rivers that are used to cool nuclear plants. We heard, today that EDF in France is going to anticipates cutting production generation out of one of its nuclear plants there due to those rising river temperature levels. So yeah, big cooling demand, power demand increase at the same time affecting the amount of power that can get to the grid.
So how is Europe dealing with this extreme weather, Joe?
Well, they've sent out a lot of heat alerts, a bunch in the UK covering, the south and the east, including London. We got red alerts in Portugal and heat alerts all across Spain and almost the entire, entirety of France, really. Warning people that temperatures are going to be high and warning people that the temperatures at night are not going to cool down. That's a big deal. It obviously makes it uncomfortable to sleep. Many homes here don't have air conditioning, but it's an extra concern for young kids, older folks, and people with health vulnerabilities, not having that ability to cool down and get any of that relief at night.
Joe, thank you so much. Joe Vertz there, our weather and climate reporter. Now, we're just getting some breaking news out of the ECB Vice President, Mr. de Guindos, says he hopes there's a U.S.-EU trade agreement by July 9th. He also says there are doubts regarding U.S. reflected in the dollar. Mr. de Guindos going on to say that the euro could be a reserve currency if Europe does it right. Now, this week, Bloomberg is live at the ECB Forum on Central Banking in Sintra, Portugal. Join us tomorrow as I host a policy panel with the world's top central bankers. That's at 2:30 p.m. London time. And then the U.S. Treasury Secretary Scott Bessent will also be speaking to Bloomberg later. Catch that conversation at 2:30 p.m. London time today. Up next, Bloomberg Brief, and this is Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday. A new record. U.S. stocks hit an all-time high as a tumultuous first half of the year comes to a close. Deals take shape just 9 days to go until President Trump's trade deadline. Negotiations continue from Canada to Japan. And the Senate about to kick off a marathon voting session on the president's tax bill ahead of July 4th. Well, it is an all-time high. It is a shortened holiday week, and it is the last day of your trading for this, what has been a roller coaster of a first half of the year. Who thought after all of that we'd be at all-time highs? But yes, it is the NASDAQ leading again, up 0.5%. S&P on track for another record close this session. Meanwhile, bond yields, those also come in, trading just about at the lowest level since the start of May. We're down by about 2.5 basis points for both your 2- and 10-year yields. Some big risk events to look forward to this week. We're going to get jobs on Thursday brought forward because of the holiday, but that holiday, July 4th, is the tax deadline for the United States. Let's look at the stocks under the surface. With your stocks to watch this morning is Joe Easton. Hey, Joe.
Hey, Danny. So we have got some weakness in the renewable energy stocks today. So I'm talking wind and also solar as well. There is a tweak on the Senate bill relating to tax credits over the weekend, potentially meaning these tax credits could end by 2027, so actually sooner than expected. And that is weighing on that renewable energy space this morning. Keep an eye on those stocks in the early trading. Then over in the other shares, I'm looking at Disney. This one gets an upgrade over at Jefferies today. It's all about Disney World doing better. Everyone heading off to Disney World over in Florida for their holidays, and also the slate for Disney looking better. Avatar 3 coming out. This is why I love covering US stocks, because we get to learn about the new films coming out. Avatar 3 is going to be a boost for Disney, according to Jefferies. So they upgrade the stock today. And then finally, keep an eye on Juniper Networks, because the DOJ has actually settled a lawsuit around the takeover by HPE, Hewlett-Packard. They won't have to go to trial now, and therefore that is positive on that takeover going through. It's up 9%. And keep an eye on the before the bell opening wrap on the terminal for more of these movers and more, Danny.
Joe, thank you so much for that roundup. We'll catch up with you later in the hour. Also in this hour, in just moments, we'll be speaking to Jane Foley of Rabobank on the market's reaction to the upcoming tax bill vote. And later in the hour, Matt Gertken of BCA Research on the looming tariff deadlines. A lot of deadlines this week, and the Senate's version of President Trump's tax bill, the so-called One Big Beautiful Bill, would add more than $3 trillion to U.S. deficits over a decade. That's according to the Congressional Budget Office. Rabobank's Jane Foley weighs in with senators set to vote on the legislation in the next couple days. She writes, quote, despite the better tone in treasuries, the market cannot escape the forthcoming vote in the Senate regarding Trump's mega bill on fiscal policy and associated concerns about the sustainability of the debt mountain. Joining us now is Jane. She's the head of FX strategy at Rabobank. Jane, great to see you on this Monday. A holiday week, but a lot coming up. Is the market prepared? To what degree is growing deficit concerns priced or not priced in?
Well, to be honest, I think some of the attention from the impact on the deficit, the debt, has been sort of watered down a little bit by this perception that perhaps growth in the US isn't as bad as people had feared. Now, clearly, we should all be worried about deficits. We should all be worried about debt, and that goes for a number of countries. But when growth is doing better, well, we need to be a little bit less worried. And right now, I think we look at the optimism with respect to the US stock market, for instance, over the last few weeks, and it does appear that some of that focus has shifted a bit. And that really is quite interesting, because all year we've been talking about this diversification trade from the US, and movement away from US assets of all types. And yet, in June, we've seen that sort of trade a little bit more confused, with the stock markets outperforming European stock markets quite substantially in June. And that, I think, raises a lot of questions, perhaps puts a lot of fog over the outlook for US assets for the remainder of the year.
Jane, if you are seeing that fog come back, as in the US exceptional trade ending isn't as clear cut, why isn't the dollar doing better then?
Well, that's exactly the question. Now, look at the stock markets. You've seen the Europeans lag the US over the course of June, and yet the euro is outperforming the dollar still, quite obviously. And that raises the question, well, which one is going to give? Now, I think perhaps there is a lot of optimism in the euro. We are likely to hear Lagarde again at Central talk about the opportunities for the euro as a reserve currency. So we are likely to get even more of that vocal optimism. But if we don't get the data coming through for Europe in terms of the economic data and also the earnings data for the stock market, then we've got to ask, is there just a little bit too much optimism in the price right now? Do we need to see some backtracking back, some favor of the dollar in order to really adjust this and take stock?
Well, if you look at some potential drivers of continued weakness, Jane, there's been a new bout of dovish Fed speak, let's say, with Mickey Bowman joining the fray of Chris Waller. The economic data does suggest that inflation has been tamed, and maybe some of that diversification trade still ongoing. Jane, what does seem to be the biggest driver of dollar weakness at this moment?
Well, I think right now it is really the Fed. The market had been thinking, the Fed going to be more worried about the inflation aspect or the growth aspect. The market was, very split upon that. If it was worried about the inflation aspect, we'd have less easing. If it was more worried about the growth aspect, we'd have more easing. And certainly over the last week or so, the market does seem to have shifted and think, well, that the Fed is going to ease. And that, of course, that optimism about easing really supported, really injected by the comments that we had from Trump on Powell really quite recently, just about a week or so ago. So the market is very optimistic about the prospect of interest rate cuts. I think that is also a risk. It could be that the market's just priced in too much. It's certainly our view here at Rabo that the market is priced in too much in terms of Fed easing. And if that reverses, or even when that reverses, that could also be a trigger for a little bit more gains or a little bit of backtracking, shall I say, in the value of the USD.
Jane, the other thing that you and the team have been writing about, I think is really interesting, just looking at some of your research from earlier last week, you talked about how the NATO summit ended on a more congenial tone. And then you also had the U.S.'s participation in Iranian strikes, which leads us to a U.S. that doesn't seem as isolationist as maybe it did at the outset of Trump's presidency. Is all of that also dollar positive?
I think if we step back and look at the big picture, well, yeah, it really should be, because again, one of these big themes that people have been talking about this year is the isolationism, the reinvigoration of U.S. isolationism, which has been around, since Washington, been around for a long time. So a reinvigoration of that, what is that going to do to U.S. hard power? What is that doing to U.S. soft power around the world? What does that mean for the U.S. as a reserve currency? So these have been some of the sort of big themes that have been kicking around, for months now. And yet, because we had the U.S. participating on those strikes just over a week ago, we do, and because of that tone, of course, in NATO just last week, then there may be that the U.S. or Trump, I should say specifically, his brand of U.S. isolationism perhaps is not as extreme as we had indicated, as a consensus just a few weeks ago. So that could be something that really does, so to speak, or pan out in the broader picture over the next couple of months.
Jane, should that also fuel some optimism that as we approach that July 9th trade deal deadline, that more positive outcomes will come from it?
Well, I think there is a little bit of optimism over the past few days. I mean, certainly over the weekend, there was a little bit of concern and then relief about the potential progress with Canada. But we've also seen some Trump officials indicating that we could have some deals done with quite a few of the US's trade partners, by that July 9th deadline. The EU is clearly a big one. It's very difficult to tell how those trade talks are really progressing now. And we did have the French finance minister suggest that there may be a need for an extension of that deadline, although this morning the comments or the political comments that we're seeing are perhaps a little bit more reassuring that there might be something done by July the 9th. It would be really nice to hear a little bit more in terms of content of that trade deal, and hopefully that will be the case by July the 9th.
I think we're all looking forward to getting any details. Jane, thank you so much for starting the week with us. Always a pleasure to have you on. Jane Foley there of Rabobank. Let's get you now some other stories that are trending on the terminal this morning. President Trump says that he has identified a buyer for the U.S. operations of TikTok. but did not identify the winning bidder. He spoke to Fox News about the potential sale.
We have a buyer for TikTok, by the way. I think I'll need probably China approval. I think President Xi will probably do it. Very, very wealthy people. It's a group of very wealthy people.
And the Senate is poised to approve a controversial provision preventing some states from regulating AI for the next 5 years. The initial provision was for 10 years. The measure was a top priority for tech companies like Microsoft and Meta. Meanwhile, ING cutting 230 jobs, saying that they have, quote, too many senior roles. Focus will be on its wholesale banking division. The restructuring will be split proportionally across locations. Coming up, trade talks gain momentum as President Trump's tariff deadline nears. We're going to have the latest developments coming up next on your Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
You're watching Bloomberg Brief on this Monday morning. I'm Danny Berger in New York. Canada has dropped its digital services tax on tech companies such as Meta and Alphabet in a move made to restart trade talks with the U.S. Last week, President Trump said the U.S. holds all the cards in negotiations.
Canada's been a very difficult country to deal with over the years. You know, we hear Canada, we have a great relationship with the people of Canada, but it's been very difficult, and they put a charge, and they were a little bit early. We found out about it. So, and we have all the cards. We have every single one. We don't want to do anything bad, but they have economically, we have such power over Canada.
Canada says the two countries will work towards reaching a deal by July 21st. For more, we're joined by Brendan Murray, who leads Bloomberg's trade coverage. Brendan, to what degree is this just instructive of how aggressive and how much pressure the Trump administration will be putting on nations as we reach the deadline for reciprocal tariffs?
Yeah, exactly. We're coming down to the real crunch time now with just 9 days to go until the tariff deadline. This move by Trump to target Canada's digital services tax is just another reminder of how wide the arsenal is for him to threaten countries and put leverage on countries to do the deal he's looking to do with them. There are other countries in Europe and Asia, in emerging markets, that either have proposed digital services taxes or have them already in place. So you have to imagine that they're waking up in capitals all over the world going, we better have a plan B for our digital services taxes. If this is a reminder from Trump that he really despises this measure, and he will use it in these trade negotiations.
Brendan, I mentioned there that Canada said that they hope to have a deal by the 21st of July. We also heard from Treasury Secretary Scott Bessent on Friday saying that he hoped we'd have deals by Labor Day. How real is the July 9th deadline?
Yeah, it seems like it's pretty flexible. The president said that he could push it back, he could pull it forward. It's kind of all over the place. We don't really know exactly how many deals they're going to wind up with before Wednesday of next week. It could be anywhere from 5 to 12, maybe, given the information that we're getting from the administration. But the bottom line is, as we report today, these deals are going to be pretty thin. They're going to be framework deals that cover a few of the major issues, and it leaves the more contentious measures, the ones that need to be hammered out over the next weeks and months, to deal with at a later date. But President Trump has said that he wants some of these deals in the books by July 9th, and you can imagine his Commerce Secretary, his Trade Representative, and Treasury Secretary are going to try to deliver on that in some form or fashion.
I mean, you can only imagine how busy the next couple days are going to be, Brendan. But Trump yesterday, speaking on Fox, saying that, look, we make deals, or I could just send out letters. Something he said before, just send out letters assigning tariffs to various countries. What could that potentially look like?
Well, that would just put the heat on these countries to come back with a better offer. If the tariff on the European Union, for instance, goes from 20% to 50%, that's going to put an immediate squeeze on the EU economy and disrupt all sorts of businesses that trade between the U.S. and Europe. So if the president feels like these countries haven't done their part to negotiate in good faith, he said that he will follow through and put these higher tariffs on their imports. But you got to imagine that countries are racing to figure out where they can find a deal, or at least buy themselves some time to work this out over the summer into Labor Day, as the Treasury Secretary suggested.
Hey, Brendan, I have no doubt we're going to be talking about this all week. Thank you for joining us. We'll also catch up with you hopefully later in the hour. Brendan Murray of our Bloomberg Trade team. Now, elsewhere in D.C., President Trump's so-called Big Beautiful Bill still facing competing demands ahead of the president's deadline.
We would still like to meet that July 4th self-imposed deadline, and the president likes that idea. I certainly like that idea, and so does Leader Thune.
But first, Majority Leader John Thune has to work through a list of approximately 8 senators of the Republican Party, with a vote happening today at 9 a.m. Eastern. Joining us now from Washington is Bloomberg's Kasia Klimanshinska. Kasia, where do the sticking points still remain to get this bill done?
Good morning. It was another busy weekend here in Washington, D.C., with Senate Republicans working all Saturday and Sunday. They took a short break, I guess, to catch a nap, but they will be back at 9 a.m., as you mentioned, voting first at the amendments, and the big final vote can happen late tonight or early tomorrow. But as you said, there are still sticking points. Republicans have only a relatively narrow majority in the Senate. They have 53 Republicans there, so they can only lose 3. And 2 already said that they pretty much oppose the bill. One of them is Rand Paul of Kentucky, who obviously doesn't like that this bill contributes $3.3 trillion to the nation's deficits over 10 years. And also the bill has a $5 trillion increase of debt ceiling in it. So that's why Ron Paul said he will vote against it. There are other Republicans. Some of them don't like the cuts in spending to healthcare. Some of them actually think that there are not enough cuts in spending in this bill.
To that point, I mean, we heard from Tom Tillis announcing his retirement over the weekend and then goes on the floor and slams the GOP tax bill, essentially saying that it's an artificial deadline and doesn't like the plan for Medicaid cuts. Just how steep is the road for Johnson to try to collate some of these Republicans? What sort of horse trading needs to happen, Kasia, in order to get them on board?
Yes, so remember, this bill has already passed the House once by just one vote. So we'll probably see another very narrow margin in Senate. And we know that the Vice President J.D. Vance was on the Hill over the weekend. He's ready to come in and, cast the vote to break the tie. So we'll see. But also we had the world's richest man, Elon Musk, speaking again against this bill over the weekend. So that obviously doesn't help.
Yeah, Kasia, just on that, it seemed like some of the industry was quite stunned with the new tax on wind and solar projects. What did we hear from Elon Musk and others?
Yes, exactly. So Elon Musk said that this bill is very destructive. Previously, I think he focused on the impact on deficits, but this time he pointed the impact on industries. He said this bill supports the industries of the past while hurting the industries of the future. Obviously, one of the industries he was thinking about was electric vehicles. This bill, the Senate version, is very aggressive. It takes away the very popular tax break for EVs for individuals.
And we've already seen some of those renewable energy stocks decline in the pre-market trade. Kasia, thank you so much for joining us this morning. Kasia Klimenczynska in Washington. Coming up, we're going to take a look at some of the top headlines around the world. Stay with us. This is your Bloomberg Brief on this sunny Monday morning.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. It's Jobs Day, and Bloomberg has the report under surveillance.
There's this feeling the labor market is contracting.
There's some risk that layoffs are growing.
Medium-term outlook is the economy should be fine.
This Thursday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The weakening trend continues.
This is a trend. We're seeing declines.
If you're not with a job right now, it's harder to find a new one.
The June Jobs Report, Thursday on Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news. Here's what's making headlines on the top publications. The New York Times has this. Republican Senator Tom Tillis announces that he won't seek re-election. President Trump had threatened to back a primary challenger against the North Carolina senator because of his opposition to the tax bill. The decision could help Democrats flip the Senate in the 2026 midterm election. Next up on the Journal, Republicans declare the extension of 2017 tax cuts as, quote, free. They're saying the extension will have no effect on the federal budget. Senate Minority Leader Chuck Schumer called the move fake math and accounting gimmicks. And on the FT, U.S. shoppers are ditching Shein and Temu. That's after President Trump closed a tax loophole. Temu's monthly active users plunged 51%. Shein saw a 12% drop. And as we head to the half hour, U.S. stocks continue to head higher. We're on track for another record close today, but it is a dollar that keeps weakening. We're talking to Jane Foley about this, breaking the trend of U.S. assets getting attractive, but the dollar not playing along. Coming up, trade talks make progress. President Trump's deadline looms for tariffs. That comes July 9th. Tax deadline, that comes July 4th. We'll discuss all of that with Matt Gertkin, Chief Geopolitical Strategist at BCA Research. That's coming up on your brief. You're watching Bloomberg.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday. A new record, U.S. stocks hit all-time highs as the tumultuous first half of the year comes to a close. Deals take shape just 9 days to go until President Trump's trade deadline. Negotiations continue from Canada to Japan. And the Senate is about to kick off a marathon voting session on the president's tax bill ahead of a July 4th deadline. The last day of a roller coaster of the first half, and we are ending with all-time highs on the equity market. Those gains continue this morning. The NASDAQ outperforms, both up around 0.5% this morning. You're also looking at declines across the bond market, 2-year yields, 10-year yields, all of those around their lowest since the start of May, down by about 2.5 basis points this morning. 4.25 on your 10-year yield, but it's going to be a busy week. It is a holiday shortened week. We're going to get Jobs Day on Thursday, 113,000 is the estimate for the Jobs Day, and then the next day after that, on the July 4th holiday, is the deadline for the tax bill. Let's look at what's moving underneath the surface. Here with your stocks to watch is Joe Easton. Hey, Joe.
Hey, Dennis, we've got renewable energy stocks sliding in the pre-market today on the latest update to the tax bill over in the US. The Senate over the weekend announcing a potential tweak to the bill, which will see tax credits end by 2027. So that would be sooner than expected. So we're seeing Sunrun down around 2%, Enphase dropping 4%. NextEra as well. That's a $100 billion company. That company seeing the shares weakening today. Then over in the entertainment space, Walt Disney getting an upgrade. This is mostly due to the parks business, which is seeing better traffic than expected, according to Jefferies, and also the slate on Disney Plus looking stronger. And the new Avatar 3 coming out in December. The analysts over at Jefferies getting very excited about that one. That is why I like covering these US stocks. Get to hear about the latest films coming out. Avatar 3, keep an eye for that one. Then over in telecoms, Juniper, this one rising as the Department of Justice settles the case related to HP Entertainment's acquisition, HP Enterprises' acquisition of the firm, and therefore this deal more likely to go through. So Juniper gaining around 8% in the pre-market, Danny. HPE was slightly higher as well. Keep an eye on those two as we head towards the open in New York.
Joe Easton, our movie theater correspondent. Thank you so much for your work this morning. Really appreciate it. All right, back to one of our top stories. Canada has dropped its digital services tax on tech companies like Meta and Alphabet in a move to restart trade talks with the U.S. Last week, President Trump said the U.S. holds all of the cards in negotiations.
Canada's been a very difficult country to deal with over the years. You know, we hear Canada, we have a great relationship with the people of Canada, but it's been very difficult. And they put a charge, and they were a little bit early, we found out about it. So, and we have all the cards. We have every single one. We don't want to do anything bad, but they have, economically, we have such power over Canada.
Canada says the two countries will work towards reaching a deal by July 21st. For more, we're joined by Brendan Murray, who leads Bloomberg's trade coverage. Brendan, it was a blink and you miss it spat. Where do we stand on negotiations between the U.S. and Canada?
Yeah, this was a reminder that as we head into these final 9 days of negotiations, Donald Trump can end talks just as easily as he started them. He said there that that the U.S. holds all the cards over Canada. That may be the case, but when it comes to a relationship like the U.S. and China that we've seen over the past week or so, President Trump may have some cards, but China has all the rare earths. So there is some room here for other countries to negotiate and to try to use their leverage over the U.S. But in this case, we saw that President Trump basically turned that digital services tax, turned it right around within a matter of a couple days. That will be another reminder to other countries that are negotiating that anything is on the table and that things can change very quickly.
How confident is this administration, Brendan, that it can get the deals it wants done by July 9th?
There seems to be some confidence that they can get a few of them over the line. There are talks with India that the president has said he's very optimistic about. We've heard them be more optimistic about the European Union and countries in Southeast Asia like Vietnam and Indonesia that could be close to deals as well. But there are others that sound like they're less sure. South Korea and Japan are among those that are facing not only the reciprocal tariff increases, but the big sectoral tariffs on cars and steel and aluminum. So the talks are getting very complicated here in the final days. You don't put your best offer on the table until the very end, and we're still not at the end yet where the best offers have come forward. So the administration will want to rank those that they see as the best. Those will get over the finish line by July 9th. Those that they say aren't as good as they could be, we could see some delays or pushing back of that July 9th deadline.
Yeah, it sure feels like we're far away from the end. Brendan, thank you so much for your work this morning. Brendan Murray. Now, Matt Gertzkin of BCA Research says now is the time to play defensive. He writes, quote, global financial markets face a new bout of volatility this summer as the Trump administration tries to renew tariff implementation. The shock may not initially be as bad as in April, but this time the real economic impact of tariffs will start to be felt. Matt joins us now. He's the chief strategist for geopolitics and U.S. policy strategy at BCA Research. Matt, so great to see you. Thanks for coming into the studio this morning.
Well, thank you for having me.
A lot to impact there, but I guess just on the basic level, it's a market that feels sanguine that either will get trade deals or it will just be can kicking. Should the market be so sanguine?
Yeah, definitely not. Trump still has an interval where he can push this coercive diplomacy. I think the markets feel more confident that he's aiming to get deals done. It's very clear across ceasefires and trade deals that this is part of the art of the deal. And so from that perspective, the financial markets want to just climb the wall of worry. And they will do that, but in order for the negotiating leverage to be successful, he's always got to surprise people. He's always got to present negative surprises. That happened with Canada just now. We see the Canadians having to sort of compromise immediately. But what we'll see is him pushing on and rotating between different countries. As usual, China ends up being the really tough nut to crack. They are effectively willing to deal because their economy is weak also. But in order for the negotiation to work, he's got to make it look like it's going to have some pain involved.
Right, so that unpredictability really a feature of his trade negotiations. But at what point is that damaging versus a market that can look through it? This idea that, yes, what he puts out there first is kind of the art of the deal. It's the first volatile thing he does, but he'll always backtrack from that so markets can look through it. So can they look through the most extreme things that he puts out there?
Yeah, generally yes, because they, as long as it's theater. But then what happens is we actually start to get the implementation of tariffs and we start to see the data change. Like import prices have been going up and consumer incomes have been slowing down. We see a fall in job openings. Young people are having a really hard time getting work. And of course, it's also hard to get credit right now. So not only have consumers spent their excess savings, but when they try to go get a loan, they have higher interest rates to pay. So all of these things mean that there's an underlying weakness to the U.S. economy, and his successes at the theater could actually be very misleading for him. It's a dangerous time in which he could be emboldened, particularly because, in general, I think his agenda has been moving along pretty well and he's gaining momentum. But that means his confidence could lead him to push harder than the underlying economy can withstand.
But I think that point is so interesting because in the first half of this year, the negotiations have taken place with an economy that's looked resilient, that's looked strong, maybe a little bit weaker at the margins. But if this next round of negotiation happens, when you're getting real-time data in that does suggest that there is weakening, is it a market that will push back against Trump? Is it a Trump that will be hamstrung because of some of the underlying weakness?
I think it ultimately will, yes. First of all, the key thing that we're seeing now is a confluence of Congress passing, the one big beautiful bill and President Trump going back to implementing tariffs. And what will come out in the wash is that the stimulus from the bill, which is, maybe a 1% of GDP fiscal stimulus next year in 2026, that's just going to sort of offset the negative effects of the tariffs. Also, the tariffs will take effect, in the second half of this calendar year, whereas really, the positive effects of the stimulus will be more next year. And so the problem there is that we'll start to see these negative effects, and you won't really see an acceleration of the economy in the way that maybe the Republicans saw in 2017 when they did the initial tax cuts. And so from that perspective, I think, in fact, we will have to find some other source of demand to make the markets feel more satisfied. But the global economy is actually quite weak. Exports are suffering from the trade war, and that will only get worse as we see effectively a large, 10% or more increase in U.S. tariffs.
I was speaking with Jane Foley of Rabobank earlier in the program, and she made this argument that when you take account of what happened after NATO, that it was a pretty congenial NATO, nothing really, no fireworks came out of it, and the U.S. that was willing to participate in the Iranian strikes, is that it's a U.S. that's less isolationist, and that should also give markets comfort. Do you get the same read from what we've seen over the past 2 weeks?
I mean, first of all, I never really bought the argument that Trump and his team were isolationist. I always thought that was a little bit of hyperbole, but certainly they were looking to retrench U.S. involvement in every, or let's say micromanaging every issue globally. They wanted to remain offshore and revert to historic U.S. sort of naval power and air power. But what we saw is that President Trump is willing to take action. So there's a credible threat that's been reestablished, and that's important for the Middle East. And it's important for other dynamics, although we still haven't fully seen those play out. So, for example, the president agreed with NATO, and it was very important that he would uphold collective security. But Russia may very well test whether that's the case. Just some sort of provocation against NATO countries to see whether President Trump is willing to defend every inch of NATO the way that President Biden said he would. And that could introduce a bit of a scare if the president hesitates. And that would undermine the faith in NATO. Also, with China and Taiwan, we'll see some testing of boundaries. Even as the trade talks are going on, there'll be a testing and there'll be an attempt by China to coerce Taiwan. So I think he does have some pretty big hurdles to go through, but he handled the Iran situation relatively well.
Well, you did write in your notes that ceasefires are never reliable. And going forward, there's still a 50-50 probability of one or several minor oil shocks going forward. It's a market that's looked through it, though.
Yeah, it has looked through it. Well, here's what I would say. First of all, minor oil shocks in general should be looked through.
Right.
And so the risk there for a while was that we would have a major oil shock, basically that the Iranians would retaliate against regional oil production, and then the U.S. would retaliate against Iran, and the whole thing would escalate. We pretty much dodged that. I mean, it could still happen, but the probabilities have fallen sharply. And so that leaves us in a zone where, yeah, minor shocks can happen, and they can happen for various reasons. But, it'll be a fleeting impact on the oil markets. And that, again, that's a really positive thing for the president, also for the Chinese economy and the European economy. So we have dodged, for now, the oil shock risk that I think was one of the bigger macro risks for this year.
Matt, just before we let you go, July 4th tax deadline, does Congress get it done in time?
I don't really think so. I mean, we're in the tactical moments now. We're in the trenches, but they've still got to get the House to agree, and the Senate bill has been a little bit more profligate than the House bill. So now those sort of fiscal hawks in the House will be the key bottleneck, and I think that's going to take a little bit more talking. But probably by the time of the August recess, they'll get it done.
So at least at some point in the summer, we'll have something. Matt, thank you so much for joining. This was so wonderful. Please come join again soon. That is Matt Gertken of BCA Research. Coming up, more on that one big, beautiful bill. Senate Republicans still torn. The voting set for this morning. We're going to have more on the deadline coming up next on Your Brief.
Technology is embedded in every aspect of our lives
and laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The yeas are 51, the nays are 49. The motion is agreed to.
The Senate may have been successful restoring major Medicaid cuts to President Trump's signature economic legislation, but it's a long road ahead before the July 4th deadline. Joining us now on that road ahead is Bloomberg's Kasia Klimanshinska. A long road, but the deadline is fast approaching. We're just speaking with Matt Gertzkin of BCA Research, who says that he doesn't think that they'll reach it. Where do the sticking points still exist, Kasia? How likely does it seem that they can get a deal done by July 4th?
Good morning. I'm not sure I agree with Matt. I think this deadline, although artificial, it was set by President Trump, and the Republicans will try to get there. This bill represents almost entire Trump's domestic agenda. It has $4.5 trillion in tax cuts. It also has increased spending on defense and on immigration enforcement. So I think John Thune is working as we speak, trying to make sure that he has enough votes. The voting will resume at 9 a.m. I think the final vote in the Senate, anyway, will happen either tonight or early tomorrow morning, and we'll see. But I think he will get there.
What about these individual points, Kasia? Things like Medicaid, things like budget expansion. Just how big of a fight are congressional leaders gearing up for?
Exactly. So there are about 8 Republican senators who oppose the bill now, but they oppose it for different reasons. So there are some Republicans who actually say the cuts have gone too far, especially the lower spending for healthcare in rural areas. That's something they don't like. They would like to restore some of this spending. But on the other hand, you have people like Senator Ron Paul, who thinks, this bill is is increasing deficits already too much. It's increasing the debt ceiling by $5 trillion. So he says he will not vote for that. And there are other Republicans who also think there should be actually more cuts to spending.
Well, we've seen some drama already on this point over the weekend, Kasia, with Tom Tillis announcing that he was resigning for facing off against Trump and being very vocal, saying that this bill is the equivalent of the ACA, of Obamacare, in terms of betraying the voter base. Kasia, he's just one who's willing to speak out so strongly because he is resigning. For the rest of this Congress, how much does Trump hold the cards? How influential is he able to be in convincing them to get this done?
Yes, exactly. So it's very tricky. Republicans only have 53 votes in the Senate. So this majority is very thin to begin with. As you mentioned, Tom Tillis, because he will not seek re-election, he doesn't have to vote for this bill, he doesn't have to support Trump's agenda anymore. So there is this one vote that Republicans will probably lose. They can only afford to lose two more. One of them could be Rand Paul, because again, even though he was golfing with Trump over the weekend, he already cast one vote against this bill and is not very likely to support it. So now we are looking at only one more, and this bill could be at risk.
All right, Kasia, thank you so much. That's Kasia Klimanshinska in Washington. Now, Elon Musk did slam the Senate's latest version of that multi-trillion-dollar tax bill, quoting on X, polls show that this bill is political suicide for the Republican Party. He is warning that the cuts to EVs and other clean energy credits would be incredibly destructive to the country. Joining us now is Bloomberg's Jamie Nemo. Jamie, just how big of a surprise was it to get some of these tax credits rolled out more quickly or rolled back more quickly? I mean, we heard there from the disagreement from Musk. Just how big of a surprise to the industry was it?
I don't think it was too much of a surprise, but it's certainly a big blow. I mean, EV demand everywhere is struggling at the moment, so the last thing they need is for the consumer incentives to disappear earlier than planned. I mean, you've seen the impact in Germany where that happened last year, and there was a real drop-off in demand, and that happened in the UK as well, where I am, pretty quickly. So you can imagine the sort of drop-off in demand there'll be in the US when these come into effect.
If it is Elon Musk that's hitting back at X, does he still hold any political sway, Jamie? Will congressional leaders, will senators, will House of Representative members listen to Mr. Musk?
I think they'll certainly listen. I mean, it's fascinating, the sort of dynamic at play here. I mean, whether he has the sort of influence he had before is unclear, but he is still chief executive of Tesla, an incredibly important company, especially in the EV space. So what he says matters. Whether they listen or not is another matter, but he's probably correct in terms of demand and what might happen when it comes into play.
What does it mean for this EV sector, Jamie, if we do see that demand drop off at a time where demand has already been challenged for EVs?
Yeah, it's incredibly challenging. I mean, it's not just Tesla, it's everyone's struggling. I mean, the US has been slightly behind on the take-up versus other markets, so you can see how that would affect things going forward. It's just another sort of blow to the whole sector that they've got import tariffs to deal with, the Chinese tariffs into the EU as well. So it's another sort of obstacle for them to overcome when they're already struggling to sell these next generation of vehicles, which are costing them a lot more to make already. So that's, getting consumers to pay extra sums is difficult. So when you haven't got those incentives to entice them to make the switch in the first place, which is a difficult thing for people, who might have range anxiety, they might be worried about the spending, is it going to run out of charge, all those sort of things. It's just another obstacle that will prevent them from making the switch, and they'll stick to gas vehicles for longer, really.
Jamie, really appreciate your coverage this morning. That is Bloomberg's Jamie Nemo. Coming up, we're going to get you set up for your week ahead with central bank chiefs gathering in Portugal and the U.S. jobs report. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading week. The ECB forum will be kicking off in central Portugal today with President Lagarde, Chair Powell, and Governor Ueda. They are all set to speak throughout the week. Then on Wednesday, Tesla is expected to release its second quarter vehicle sales figures. And then June payrolls, it will come early. We'll get that on Thursday ahead of the July 4th holiday. The estimate for that is 113,000. Now let's take a look at some of the movers this morning. Tesla, we mentioned they're going to get some of their sales figures this week. It's the only Mag 7 stock, though, that's in the red this morning, down more than 1%. President Trump's landmark budget bill passed a key Senate hurdle over the weekend, and it included a quicker phase out of some of the EV and renewable tax credits. That's also why you're seeing companies like NextEra Energy, that's falling even more, down 3%. Renewable stocks in general falling. Meanwhile, Disney, those shares are up 1.8% this morning. Jefferies has raised it to a buy. The analysts there writing that they see a limited risk for a slowdown for the parks division and upside to the cruise division. They raised their price target to $144, trading at $124 this morning. All right, a quick check on markets as we head to the end of the hour. It looks like we are set for another all-time high in this equity market in the last day of the first half of the year. S&P futures up about 1/3%. Even with all of that, though, the dollar is still weaker. It is the head scratcher, as it seems investors are more willing to pile back into U.S. assets. Yields, too, those are lower. Again, bonds, we're willing to buy those, but dollar still weaker this morning. Okay, that's it for your Bloomberg Brief. Surveillance takes it from here. You're watching Bloomberg TV.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off,
the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority and guess what, we would have never got the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
When we've had big movements in trade deals, that it does create a lot of volatility, it does create a lot of noise.
Quite quickly, we're looking to come to agreements.
We're expecting an average effective tariff rate of around 14 to 15% by year end.
I don't think these tariff deals are going to be done that quickly. I do think the tariff uncertainty will continue.
We're all looking at sort of the black box right now, waiting as this information comes out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, closing out Q2. The S&P 500 sitting at all-time highs, looking to cap off a 10% advance, even as the big, beautiful bill hits some increased resistance in the Senate and trade partners struggle to strike a deal before the July 9 deadline.
I'm going to send letters. That's the end of the trade deal. We're going to say, congratulations, we're allowing you to shop in the United States of America. You're going to pay a 25% tariff or a 35% or 50% or 10%.
A busy July is just around the corner.
Yeah, and the question really is, are we overly pessimistic or are we too optimistic at a time when you are coming off record highs for U.S. equities, good for stocks, good for bonds? They just had the best month going back to February. So at a certain point, are we baking in too much good news heading into this July 4th or July 9th deadline? Or, as I see Steve Chivarone sitting next to me shaking his head about my pessimism, are we overly pessimistic because things have continued to grind higher and we still have a lot of stocks that are lagging behind?
We said this on Friday going into the weekend. It's worth repeating again. A 10% rally on the S&P 500 in the same quarter we had April 2nd. Think back to April 2nd. That is absolutely phenomenal. And even with these two deadlines, Lisa talked through them, July 4th, July 9th, both are set to slide at this point, both July 4th and July 9th.
Well, they are self-imposed, so maybe that's a reason why potentially they could slide in and of itself. I'm accepting that. But really, when it comes to the one big, beautiful bill, this is going to be a fight because not only does Majority Leader John Thune have to get a handful of senators across the finish line, which comes back to the basics we have been talking about from the very beginning. You have these different factions, those that want to see less spending, the fiscal hawks, those that want to see more health care benefits, and those that are really concerned about what's going on with the renewables. Once you give a concession to one group, you create a whole host of problems in another group. And even if Senator Thune is able to do this within the next 12 to 16 hours, then the House has to decide, are they going to capitulate and accept what the Senate gave them, or are they going to have their own fight?
This is business for Friday. Before we get to Friday, we need to deal with payrolls Thursday. Yes, payrolls Thursday. The estimate in our survey at the moment, 113 is the median estimate. That is down from a previous read of 139.
So this is the question that I have. There's a lot of payrolls risk baked into the market, this according to a whole host of different analysts over the weekend. And I'm just wondering, what is that risk at a time when people are expecting a low print to not necessarily represent weakness, but just the low churn of less immigration, less hiring, and less firing? How do we understand this Rorschach test of numbers.
Is it fair to say the debate will continue beyond Thursday into the weekend?
That's a neat way of putting it,
And stocks will maybe sit there at all-time highs and just ignore it all?
Well, that's the question. What's the sort of, come to Jesus moment in markets where suddenly you start to say, hold on a second, we can identify a trend and it's to the weaker point. And can you get the Fed cutting rates without that type of clarity? Because if you can, then you're in the Mike Wilson camp. All systems go, things can keep grinding higher. If you're not, there's a question about whether this Fed's going to be too late. We'll see cracks.
Equity markets grinding higher this morning, up another 0.4% on the S&P 500. Coming up this hour, Steve Chevron of Federated Hermes with stocks looking to add to record highs. The former senior White House trade advisor Kellyanne Shaw on the latest trade negotiations. And Aditya Bharve of Bank of America looking ahead to Thursday's payrolls report. We begin this out with stocks looking to close out a big Q2. Steve Chevron of Federated writing the following: we expect the grind higher in equities to continue as investors that overreacted to April continue to get pulled into the market. Steve joins us now for more. Steve, good morning, sir.
Good morning.
It's good to see you. Lisa mentioned Mike Wilson over at Morgan Stanley. His line this morning: the rally has been more fundamentally driven than many appreciate. Would you agree with that?
Yeah, I think that's the point that we were making in the quote you just had up. Right, there's a tendency when you're caught short and the market rallies hard on you to want to discount that rally, and then all of a sudden, and look, at the beginning of every rally, it's short covering, or it's a bounce, or it's, hey, tariffs got delayed, not canceled. And then other things start to happen, right? The Fed gets closer to cutting, which you can see that pressure is mounting. I think even Powell kind of hinted that September is likely to happen. You start seeing things like the big, beautiful bills start to move through the pipeline. Every reconciliation bill fails at least twice before it passes, so nothing that's happening this week really kind of has me thrown off there. Trade deals of some kind are likely to come. And underneath, earnings estimates have stabilized after falling right in the immediate aftermath of April. So what started out as just a relief rally is starting to become something real, and that's what sucks those investors in slowly and reluctantly.
Is that despite the data or because of the data?
The data's in an interesting place right now because one of the missing ingredients here is the Fed moving. And you're in a scenario where if data was too hot, then the Fed has all the excuse that they need to remain on the sidelines, whereas the data is softening enough. It's softening in a way that suggests the economy is slowing, but not softening in a way that suggests that there's some major problem. It's the same thing that Lisa mentioned with the payroll report, right? It's slower, it's showing less grind, but it's not showing massive layoffs. And I think that kind of slower data that pulls the Fed in, but isn't indicative of a major economic problem, is being seen by this market as a positive.
This is the key point, I think, is that Mike Wilson pointing to the idea of good rate cuts. Not necessarily any rate cut's going to be a bad thing because it's only going to come on really weak economic data, and that's kind of what you're suggesting as well. Why are we morphing into that again when that was actually anathema to what everybody believed just a month or two ago?
Well, not everybody. That's been what we've been screaming. I mean, look, I've been on this show at least once or twice a month for the last several months, and we've been wanting the Fed to move in the direction of at least preparing the market for cuts. And the reason why is not because we see a big problem, but because if the Fed can move earlier and gradually, then you have an economy that's slowing, and it is the good kind of cut. It's preventing a problem from coming. If you wait too long and you let those pressures in the economy build, then you find yourself behind the curve, and you're in a scenario where you've got to cut much quicker, and it's because you have a problem. So I think you're on that cusp here, and if they move in the next two meetings, I think that's probably fine.
So we've been talking extensively about how the S&P 500 is not the economy, and increasingly we've seen this divergence, and it's increasingly being led by the big tech names, and it really hasn't been led by everything else. You're starting to see small signs of broadening out, but how crucial is that broadening out to this idea that this is a durable rally that can get to 7,500 within the next 18 months?
I don't know that it's been that narrow. I mean, it has been narrow, but remember, during the April sell-off, Mag 7 got to a 2-3 year cheap in terms of valuation. It was the one thing we bought, and we've been in the camp of kind of broadening out now for a couple of years, but during that sell-off, it really was the large cap tech that took a big brunt. What you've seen since, though, is look at small caps. Small caps have participated since the April 9th bottom. It's some of the value names that have underperformed, but that's because their last earnings season was a little disappointing. So I think, yes, it has been growth-led. I don't think this is just a story of growth, though. I think this is a little bit broader. I do expect you'll see it broaden out. I don't know that you have to right now. I think this is a pretty healthy rotational rally.
When you look at the tax and spending bill going through Congress, and you say it's going to be moderately stimulative to the domestic economy, what parts of the domestic economy?
Well, I think you're doing a couple of things. I think you have to take it into account with tariffs and the tariff revenue, assuming something like a 10% across the board. When you do, all of a sudden, what looks like a $2 or $3 trillion increase to the debt just from the one big beautiful bill becomes something, when you add tariff revenue, that's basically debt neutral. If you add in a little bit of a higher growth rate, you can actually get to deficit reducing over the next 10 years. So it's not a big, huge stimulus bill where you're blowing out the deficit. But what you do see is using some of that tariff revenue, of which probably half is borne by the U.S. taxpayer, half by a foreign taxpayer, you're then delivering $4.5 trillion of tax cut extensions, plus a little bit extra.
But does the American consumer feel it? If they're getting a tax cut from Washington, but they're paying more for their everyday goods because of an increase in tariff from goods coming into the United States, is it basically just equal? Do they cancel each other out?
If you were just extending the 2017 cuts, I would say yes, then it cancels out. I think what you have here, though, is lower and middle income Americans feel the brunt of those price hikes the most. Rich people don't get paid in tips. Rich people don't get paid in overtime. I mean, I've tried to reclassify my bonus as a tip, but it doesn't work. Like, but the point I'm making is that when you actually think about those particular new provisions, no tax on tips, no tax on Social Security, those are really designed to help out lower middle income Americans that would feel those higher prices. And then I think the other provision you can't sleep on is the immediate expensing of CapEx. Because in the past, that's always been equipment, but this is plant and equipment, which I think will allow companies who might be reticent and want to wait out the administration in terms of investing in the United States to have such a good deal on plant and equipment that they may do it now.
Stephen Murray promised to sort out that bonus stuff, didn't he? Last time he joined us.
He said he would talk with the management. Let's see how that goes.
Looking ahead to payrolls on Thursday, Steve, just to squeeze this in. The estimate in our survey is 113. There's a whole bunch of reasons why we might get a softer than expected print down near 100K. Does the market have the capacity to absorb a downside surprise on Thursday morning?
I think it does, depending on how the Fed reacts. I mean, the labor market has clearly slowed, right? Whether or not that number is a little higher or a little lower, we know it's slowed. You can see it. You see it in wage inflation. You see it in some of the claims data. It has slowed. And so the question is that slowing going to be met with more dovish policy? And then it's just a slowing and doesn't morph into something more significant. I expect it will, but we'll see.
Any sign of that coming from Chairman Powell?
As much as he's been locked in, I think I saw the first set of cracks at the testimony last week.
What stood out for you?
This idea that he, A, admitted that most of the committee sees cuts this year, and B, he seemed to hint that September would likely be in play unless we had a big inflation surprise. I mean, look, in a perfect world, I think it probably should be July, but if it's September versus July, that's probably not the end of the world.
Steve, it's good to see you. Constructive and right through much of Q2. Unexpected. A few months ago, being constructive and bullish this market in early April, that was dangerous stuff back then. Sounds great now, but that was a trade for the brave back in early April.
And now it's a trade for the prescient when you look back. And the question is really, can we continue forward with the same kind of momentum at a time where there are these big risks? And what Steve is pointing to is all those people who are still saying, are we too optimistic, are the reason why this market will continue to go higher.
Steve mentioned Chairman Powell. Chairman Powell will be speaking tomorrow in Sintra, Portugal, alongside a whole bunch of central bankers, so look out for that in the next couple of days. In the meantime, let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Good morning, John. Senate Majority Leader John Thune is working to pass President Donald Trump's tax and spending bill by July 4th. But Thune is facing opposition from 8 Republican senators and must find a compromise between factions of his party. Some are pushing for deeper spending cuts, while others are seeking more funding for health benefits and renewable energy subsidies. Meanwhile, Canada is making a move to try to jumpstart trade talks with the U.S. It is withdrawing its digital services tax on technology companies such as Meta Platforms and Alphabet. This comes after Trump said on Friday he was ending all trade talks with Canada in retaliation for the digital tax. And online retailers Temu and Shein have seen user growth plunge after President Trump imposed steep tariffs on Chinese goods and ended the de minimis loophole. The Financial Times is reporting Temu's monthly U.S. active users plunged more than 50% to about 40 million users March through June. It reports the companies have switched their focus to Europe. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the tax bill hitting some resistance.
I want to move on to the big, beautiful bill. Do you think you're going to get it in that time?
Problem is, if we're 2 days late or 5 days late, everybody says, oh, you had a tremendous failure. Whatever it is, as long as we have it, it's very important.
Up next on the program, we'll catch up with Terry Haynes of Pangaea Policy and get you the latest from the nation's capital with Bloomberg's Tyler Kendall. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
.40 this morning, 9:40 Eastern Time. Do not miss this conversation. The Treasury Secretary, Scott Bessent, sitting down with Bloomberg TV on taxes, on trade, on this market. In this market right now, equity futures positive once again by 0.4%. Coming into Monday at all-time highs, and we had some weight to the rally on the NASDAQ, up another 0.65. Elsewhere, under surveillance this morning, the tax bill hitting some resistance.
I want to move on to the big, beautiful bill. Do you think you're going to get it in that timing?
I don't know. I mean, I can't tell you that. I hate to say yes. I'd like to say yes, but the problem is, if we're 2 days late or 5 days late, everybody says, oh, you had a tremendous failure. Whatever it is, as long as we have it, it's very important. If we don't have it, there's a 68% tax increase. If we don't have it, you know, the debt ceiling extension is very important.
It's the latest this morning. The deadline for President Trump's big, beautiful bill could slide as the legislation faces pushback from his own party.
We owe it to the American people, and I owe it to the people of North Carolina, to withhold my affirmative vote until it's demonstrated to me that we've done our homework.
Joining us now to discuss is Bloomberg's Tyler Kendall. Tyler, good morning and welcome back to the program. Just how strong is this pushback from the Republican Party over the weekend?
Yeah, hey, John, good morning. Well, we know at least 2 Republicans who are likely no's, and that could serve a problem for Senate Majority Leader John Thune, because he can really only afford to lose 1 more before he has to call in Vice President J.D. Vance to cast a tie-breaking vote. Now, one of them we just heard from, that's Senator Tom Tillis, a Republican from North Carolina. He's raised concerns about changes to Medicaid, including lowering the Medicaid provider tax, as well as how quickly some of these clean energy tax credits are going to be phased out. The second, as you see right there, is Senator Rand Paul of Kentucky, who wants to see deeper spending cuts and really won't vote for any legislation that lifts the debt ceiling. And that really illustrates the two factions here. Yes, they agree on sort of the core tenets of this bill when it comes to the tax cuts, but they are on completely separate ends when it comes to the spending cuts. And there's about 6 other Republicans that we are closely watching that are on the fence, and Senate Majority Leader John Thune is going to have to really get them over the finish line if they want to pass this by July 4th. Now, to give you sort of the stakes that we're working with, the Senate's going to reconvene today at 9 a.m. Eastern. They're going to kick off what's known as a vote-a-rama, where essentially Democrats are going to introduce amendments, try to force some politically fraught votes, and drag out the process. That could take up to 12 hours to complete, but once it's done, then the Senate would vote on final passage, which, John, means the Senate could potentially look at passing this if they have the votes as early as tonight or tomorrow morning.
Tyler Kendall with the latest in Washington. Tyler, thank you. To build on that, Terry Haynes of Pangea Policy joins us now. Terry, in your opinion, is this real, authentic resistance or just a little bit of theatre before the ultimate inevitable later this weekend?
Good morning, John. I'm in the theater category, I think, today, and I enjoy theater, but it is theater. Political bodies always wrangle around for votes, and this is a situation where there are 53 votes that absolutely matter, and they're jockeying for the most they can get in a situation. But at the end of the day here, they come together, and if anything, the weekend saga with Senator Tillis foreshadows that, because you get a situation where there was so much pressure put on him, he's decided not to run for re-election. These guys all like their seats, and they're probably going to want to stay.
Terry, when it comes to who has the leverage right now, when there are competing factions in the Senate, which group is it?
Fundamentally, I think it's the people that are kind of the harder core versus the softer. Obviously, there's more of them, number one. Number two, they're pushing as hard as they can to get this thing done. They will make whatever smaller accommodations they have to the other faction to get some things done, but don't look for the Senate to automatically morph into kind of flip over to the soft side wholesale.
When it comes to how this legislation, this process all comes together, what is going on with the Byrd rule? Do you think we're setting up a precedent now where any party can come in and basically set policy and extend that policy within the next 10 years?
Oh, I think that's been going on for 60 years through the reconciliation process, frankly. Let me also say on the Byrd rule, what the Byrd rule is a germaneness rule, by which I mean, whether or not it should be, some provision ought to be in a budget bill or not, whether it has budget impact at all. And, those are rules of the Senate. And, I know there's all this kerfuffle about Liz McDonough, the parliamentarian, but what she's doing is faithfully executing her job as a staffer, the parliamentarian, to interpret and finalize rules that the Senate itself has put into place. So this is not a situation where the staff's hijacking some process, and it's a terrible thing for any elected official to blame a staffer for that sort of thing. This is a situation where the rules governing the particular budget process are in play. But back to your point, though, both parties have been gaming this system for 60 years, and I expect that to continue, yes.
Terry, you said initially that you do think this is more theater than an actual fissure in the Republican Party that could stymie this bill. And yet we're all playing the numbers game over the weekend that the senators, the Republican senators can only afford to lose 3 votes. And currently there are 4 that are on the line. There's Ron Paul, Lisa Murkowski, Susan Collins, and now Tom Tillis, who isn't running for re-election, isn't necessarily constrained by potentially being primaried. Who caves on that front? Why do you see this as still getting over the finish line?
Because of the sequence of votes, generally speaking, I think what Senator Murkowski, Senator Collins get is a little bit of softening on Medicaid provisions, maybe some other things that they're interested in. Senator Murkowski is always standing up for Alaska Energy, and she should, and she'll work on that. And at the end of the day, what you're going to have then, once those accommodations are made, then you're going to have a situation where you have 52 on one side and Rand Paul on the other, and they will vote for final passage there.
So we spent a lot of time wringing our hands earlier this year talking about the increasing budget deficit in the United States and how this was going to cause some sort of bond vigilante moment where you get real pushback in the bond market. We just had the best month for the bond market in terms of performance going back to February. At the same time, the Committee for Responsible Federal Budget says that this current iteration of the One Big Beautiful Bill is going to add $3.9 trillion to the deficit over the next decade. Which is it? Do you think that people are being a little overly sanguine about what this does to the deficit? Or do you think, like we heard from Steve Chivarone, that there are going to be real offsets that we haven't accounted for?
Well, two things. One, whoever's doing the interview with Secretary Bessent, I hope they'll acknowledge that he was absolutely correct on on how he thought markets would react in the medium and long term here, both on equities and in bonds. He called that, and a lot of people didn't. Secondly, sanguine, I don't know. The rules by which the CBO and outside groups concoct their views are artificial, and they exclude lots of things like the impact of tariffs and growth, frankly. So yeah, I'm on Team Steve on this one, I think.
Terry, when it comes to how this actually gets to the president's desk, what's going to happen in the House? Does the Freedom Caucus just fold like they did in 2017?
I've been for 3 months now been advising markets that this thing was going to happen on or around July 4th, and now here we are. And I've also for probably a couple of months now been advising that the whole purpose here is the Senate's going to jam the House, and the Senate bill will be the final bill. And I still think that. And frankly, if you listen, I mean, this is that buzz is kind of bubbling under right now. But if you listen to what the House people say publicly, they expect that. There's all kinds of talk about how we've accommodated the House and how we've been working together and all the rest. What that is a signal that we're going to end up having to take whatever the Senate does, and the president's going to have to come in and put the hammer down on some people.
Hey, Terry, it's good to catch up with you this Monday morning. Good morning, sir. Terry Haynes there of Pangea Policy. Is it real resistance or theatre? Terry believes it's just theatre.
Just theater, but potentially there could be real resistance, I think, with some members in the House. I understand what Terry's saying. There is some good mood music put out there, maybe from the likes of Congressman Mike Lawler. They are keeping the SALT provisions in. But then you go to Chip Roy, Congressman Chip Roy of the House Freedom Caucus. You go to his Twitter handle over the weekend. He does not like this Senate version of the bill.
Speaking of resistance or lack thereof, Lisa, you talked about the bond market. Yields down for 3 consecutive weeks, down almost 10 basis points on a 10-year just last week.
People are shrugging off this idea that somehow this is going to spur bond vigilantes into action. They're going to come with pitchforks for Washington, D.C. and say, get your fiscal budget in order. And we're not seeing it happen. And it raises this question, why? Is it because there maybe isn't as much foreign selling? And a whole host of analysts over the weekend suggested that's the case.
10-year bond yields this morning down to 4.25. Up next, the former senior Trump trade advisor Kellyanne Shaw as Canada looks to restart trade talks with the US. Plus, Danny Berger with your morning movers, renewables in focus falling on the latest version of Trump's spending bill. Live from New York, you're watching Bloomberg TV.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Coming into Monday at record highs on the S&P 500, through Friday on a two-day winning streak on the S&P, closing out last week for the biggest weekly gain since mid-May. Up another 0.4% on the S&P this morning, on the Nasdaq up by 0.7. Switch up the board and turn to the bond market. 2-year, 10-year, 30-year. Nothing to worry about in fixed income at the moment, apparently. 3 consecutive weeks of lower yields on a 2-year and 10-year. The 10-year down by close to 10 basis points last week. Down another 2 this morning, going into payrolls Thursday, a few days away. Your yield, 4.25. As yields come back down, the pressure on the US dollar is not going anywhere. In the FX market, euro dollar, check this out. The euro stronger for an 8th consecutive session. That grind continues, 117.23, the longest daily run going back to July 2023. One to watch in the FX market. That's the cross-asset picture. Let's get you some single names. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. Clean energy stocks getting slammed in this morning's trade. The latest release of the One Big Beautiful Bill having a quicker than expected rollout, phase out of those renewable tax credits for solar and wind projects. They're not going to end in 2027. The expectation is that would have happened later. So you're looking at names like NextEra Energy falling 3%, AES that's falling 2.5%. Also in the latest draft of that Senate version of the bill, you also saw a quicker rollback of EV credits or EV relief for those purchasing it. That's hitting Tesla this morning. Shares are down more than 1%. Elon Musk even taking to X over the weekend, slamming that tax bill. Finally, rounding things out with a little bit of sell-side action from you. Jefferies upgrading Disney this morning. Shares are up 1.9%, saying that there is less of a slowdown likely coming for their parks division. Cruises also look strong, and they have a really big slate of entertainment coming up over the next 6 months, including Zootopia 2 and Avatar 3, because nothing is new anymore. John.
Of course, that's just the way it goes. Danny, thank you. Was in the movies over the weekend, saw all the trailers. It's exactly how I felt. Felt like I've seen that, seen that, seen that. I haven't seen that, but I felt like I've seen that, and I don't need to see it anytime soon.
And often, you actually have seen it, because usually it's a 2, 3, 4, or 5. That is the iteration of a particular series.
Giving all of that a miss. On our radar this morning, one of our top stories, President Trump's tax bill heading for a marathon voting session in the Senate. The Majority Leader, John Thune, working to appease holdouts, needing at least 5 senators who are currently opposed to vote in favor.
So he can only lose 3, and he's pretty much already lost 2 with Tom Tillis and Ron Paul. Obviously, J.D. Vance will have to come in for one of those votes. So he needs to get one of these handful of senators over the finish line. Likely this is going to come down to the group what Terry was talking about, when those that looking to scale back how quickly they are cutting when it comes to Medicaid cuts. And that might be the reason why, because politically, this might be challenging for Republicans when it comes to the midterms. And you already look at some of the research. Pew Research is showing that most Americans actually are not down with the One Big Beautiful Bill. Maybe in terms of tax cuts, but they don't want to see things like Medicaid or any sort of health care benefits being taken away.
So this is the reason why we're going to have a Votorama, which is going to be 12 hours or more. The rabbit hole I went down this morning was, why Votorama? How did they name it that? And evidently, as recently as 1992, they started calling it a Votorama. And in 1996, it was basically codified by Republican whip Trent Lott. So we've been referring to this thing as a Votorama, which sounds like a bad term out of a 1988 sitcom. So I was just wondering, and yet here we are.
Can I recommend that you spend that time next time just sleeping? Some extra time in bed.
I actually really enjoyed it.
You just get bored at about 4:30 in the morning.
I wasn't bored. I actually was thinking, how did we end up saying this with a serious face? Votorama. Every single time it comes up, and yet here we are.
We'll do it again all through this week. That's just one of the deadlines, by the way. That's July 4th and taxes. July 9th and trade very much in focus too, with Canada making a concession to the US in a bid to restart trade talks, dropping its digital services tax that would have cost tech companies billions of dollars. The Prime Minister Mark Carney and President Trump agreeing to sign a new deal by July 21.
So two things we learned from this. One, there is going to be an extension, at least when it comes to Canada and their trade discussions. When I speak to trade negotiators on the other side of the United States, if they are serious in conversations right now with this administration, they are being told from the Treasury Secretary, from Ambassador Greer, that we will give you that extension. Two, when it comes to just digital service tax, how much did this actually help Mark Carney? This was something from the Justin Trudeau world, and a lot of businesses have been going up to Mark Carney saying, please don't put this into play, and maybe President Trump actually helped him here.
I actually think Mark Carney has to be given a little bit of credit. He has brought the temperature down in a significant way. Even when you had the leaders of the world come to Canada, he didn't have them come out with some sort of joint communique. Let's not focus on that. Let's talk about real stuff that needs to get hashed out and not sort of raise the temperature on a specific number of words. You have to say, he's kind of played this in a way that has made Canada more accessible for people who might want a vacation there.
The personalities, the substance, the weaker currency, all of that stuff.
Exactly.
Can I fit one final question in? Deadlines? July 21, July 9th, China's August. What's the real deadline for all these countries?
I don't think there is one, because the president continuously also says in 2 weeks. How many times have we heard there's going to be a trade deal in 2 weeks? I feel like I've been hearing that for 2 weeks, every 2 weeks since April 2nd. So I think it depends for each country. It's specific.
We'll come back to the trade story in just a moment. Let's get to the story here in New York City. President Trump threatening to withhold federal funding from NYC if mayoral frontrunner Zohran Mamdani, quote, doesn't behave himself financially. The comments coming as Mamdani says he doesn't believe the world should have billionaires.
And this raises this issue of the U.S. federal government versus local municipalities and their governments. You have seen this type of threat raised before. What I find interesting is there is a split right now in MAGA world about people who find this abhorrent and people who maybe aren't so much in that camp. Tucker Carlson, over the weekend, coming out and saying that Zohran Mamdani was the only person in the New York City's mayor debate to say he wanted to focus on New York City. All the other candidates said Israel. I just think it's interesting to see this split, because if you start to look at some of the rhetoric, it starts to look very similar on either side when you go far enough to the fringes.
I saw that clip with Marjorie Taylor Greene, and she said, yep, he gave the right answer. He was the only one that said, I have no reason to travel anywhere but to stay right here in New York. We have seen the president do this before. He did it with Governor Newsom. I'm going to withhold funds if you don't do what I like to do. If Zohran Mamdani actually becomes the mayor of New York, that is going to be an incredibly tense relationship between Washington and the financial capital of the world.
And could be very complicating for that Democratic Party going into the midterms next year and trying to secure what their future looks like into the next presidential general.
Absolutely, because a lot of Democrats that are more moderate, that are more, I would say, centrist of their party, have come out really strong against Mamdani and have actually also, some of them said, I'm not ready to give my backing to this individual.
That's the latest on New York City. The countdown to that election in full swing. Let's get back to trade. Global trade partners looking to strike a deal before President Trump's self-imposed deadline on July 9th. The former senior White House trade advisor Kellyanne Shaw writing the following: I'm expecting to see most tariffs land between 10 to 25%. Kellyanne joins us now for more. Kellyanne, welcome to the program. What leads you to that conclusion, Kellyanne? 10 to 25?
Thank you so much for having me. And I do agree with Anne-Marie. I think July 9th is feeling less like a deadline and more like a mindset in terms of how I expect to see some of these relationships roll out. I think that 10% is the safe zone. That's where the president has kept us for the last almost 90 days. And 25% is a really high tariff. So I expect after all of these negotiations that the countries who get the best deal, like the UK, will end up with a 10% baseline tariff. And my expectation is that for everybody else, 25% is probably probably the upper range. Plus, we have some of these sectoral tariffs, and we're getting some of those indications from administration officials who are signaling that to the private sector as well.
I like that. It's a mindset. So in this negotiation of mindsets with all of these countries, what is the order, the pecking order of who gets a deal first?
Well, I think we're likely to see a mix of countries. And clearly, the administration has been targeting our biggest trading partners, those with whom we have the largest trade deficit, as the prime targets for the president's trade policy, because if you get that right, everything else can flow through there. But what I expect to see is actually a mix. I think we'll see some large trading partners. I'm actually starting to put the European Union in that bucket. The president's talked about India. We could see some Asian countries as well, Latin American countries, other European countries like Switzerland. Maybe we see Brazil, Argentina, and countries like Israel in there. And then the president is going to assign a tariff rate to everyone else and give them the opportunity to come back and to renegotiate if they want something lower. So I think we'll see all of the above.
So it feels like he'll just be negotiating for his entire term. Is that how you take it?
Well, if it's anything like Trump 1.0, then yes, I think this is a perpetual negotiation that we'll continue to see unfold. But here's what I really think we'll see, that over the next couple of days, starting with July 4th and rolling into July 9th, we'll see a series of deals announced. And these will effectively be like agreements in principle over some core obligations. And then the details of those deals will need to be further negotiated. And Secretary Bessent has talked about Labor Day as a potential target date for finishing up some of those negotiations. And I think we'll see more stability in the market from there. But this is continually a moving target. And I think countries who want a better deal 6 months, 2 years from now will have the opportunity to get that.
So let me get this straight, Kellyanne. We're talking about July 9th soft deadline for concepts. And then for some more details, we're talking about Labor Day. What do companies do with all of this? I mean, are they paying the de facto tariffs at any given time? How do they sort of follow rules that have not yet been codified?
Yeah, I think those are really great questions. And I do think that we'll start to see a lay of the land come July 9th. And I think we'll see a greater lay of the land come this summer, fall. And that's where I really think the private sector is going to have more certainty as to what some of these tariff rates are likely going to be for the long haul. But I don't think we'll ever get that certainty because we also have these sectoral tariffs that the administration is continuing to roll out. We've heard that they have 6 or 7 more investigations in the hopper of different products and sectors. So I think we'll continue to see this evolving, but I do think we'll get more certainty through the summer.
So there's been this theory out there that we'll see some of the trade negotiations and the trade deals that we've been discussing trickle into the economic data and trickle into earnings as soon as the next few weeks. Do you think that's feasible given the fact that companies don't have certainty and aren't willing to make big moves on either a supply chain level or even on a pricing level before they have that clarity?
Yeah, and I think the other thing that's in play right now is the one big beautiful tax bill. And so what the administration would say, of course, is that it's not just our tariff policy, our trade policy, but you have to look at our tax policy, deregulations, energy diversity, all of these things to get the full picture as you're taking steps to invest in the United States and set up some of those supply chains. But I think for some of these sectoral tariffs, those are going to be stickier. So companies who are in steel, aluminum, automotive, semiconductors, pharmaceutical products, I think they'll see some more certainty sooner. But I do think for everyone else, if you can sort of bake in an estimate of a 10 to 25% tariff, depending on where you're importing from, that's probably a good estimation of where things are going to land. And that's what I'm telling my clients.
An entire trade conversation. We haven't talked about China yet. Kellyanne, just what's the next steps when it comes to this relationship between Beijing and Washington following the Geneva and London talks?
Yeah, I think things are going very slowly at the moment. And so right now we are working on implementing that original Geneva deal through the London framework. And so all eyes are focused on some of these export controls. On the Chinese side, rare earths and rare earth magnets in particular. On the U.S. side, some of the countermeasures that were taken. The president mentioned yesterday that the chokehold the U.S. has is on China's aircraft and aerospace industry and that they need us for that, the same way we need them for rare earth magnets. So I think we need to see a de-escalation with these two sectors right now in the next few weeks. And at that point, that August 12th deadline was supposed to be the date where we saw a broader set of economic commitments being negotiated between the United States and China. But I do think the focus of August 12th is going to be relatively narrow, both on implementation and maybe seeing phase one roll out. But this is going to be a difficult relationship, and I think we're going to see this play out over the next year or two, not just the next couple of weeks.
Kellyanne, a few more years of this. Can't wait. Kellyanne Shaw, the former senior Trump trade advisor. I'm not sure the market can cope with that, which is why the market's just started to ignore it all over the past 2 months.
How do you price in tail risk? That every day seems catastrophic and every day doesn't materialize anytime soon. It just, you ignore it. And at a certain point, that's the only way to stay sane.
This is the biggest wrinkle in communicating policy at the Federal Reserve at the moment. The Fed chair gave his semi-annual testimony. He said, who's going to pay the tariffs? Who's going to pay the tariffs? Really what he should be asking is, what are the tariffs? Shouldn't that be the number one question right now?
And that's the reason why he said he had to wait until July 9th to understand the levels. Does he get those levels on July 9th? And if it still is an ongoing negotiation, how much do you end up in a situation where we don't have any sense of it and we're just throwing spitballs at the wall like we've been doing all year?
Kellyanne Shaw was at the table and negotiating with China when it came to the phase one trade deal. When she says July 9th is a mindset, I take her word for it.
Did you used to make them as a kid? Put them in straws?
You know, I was actually jealous.
Disgusting.
I was jealous of the people who could. Actually, they are kind of disgusting. But
no, it's vile. It just took me back.
Did you ever do it?
I'm sure I did.
Yeah. I did not. I do not comment.
I haven't thought about that for about 30 years.
Yeah, people also used to do other things, like wet things and throw them at the ceiling.
Talk about that another time, all right. Futures at the moment on the S&P. Markets, what were you doing last week? Social media stocks. Equity futures positive by 0.4% on the S&P. Nice. On our radar this morning, a lot on trade, taxes and policy. In the news this morning, in our Bloomberg brief, Yahara Anand has more. Hey, Yahara.
Hi, John. One of Hong Kong's last remaining pro-democracy parties has officially disbanded. The leader of the League of Social Democrats cited immense political pressure for the decision. It's the latest opposition party to cease operating after Beijing imposed a national security law on Hong Kong in 2020. Meanwhile, here in the U.S., North Carolina Senator Thom Tillis won't seek re-election. This coming after Tillis voted against advancing Trump's tax and spending bill. Trump responded on social media, calling Tillis a talker and complainer, not a doer, and said he was speaking with several candidates to launch a Republican primary bid. And Meta is ramping up hiring for its AI superintelligence group. The company signed on 4 notable AI researchers from OpenAI. Meta CEO Mark Zuckerberg made headlines this month for beginning to personally recruit AI researchers and engineers after being frustrated by his company's shortcomings in the space. I guess those $100 million pay packages are working. That's your Bloomberg Brief. John?
Yahara, thank you. If you can't buy the companies, take out the stuff.
And frankly, that seems to be what he's doing. And remember when we were talking about social media stocks? Just saying.
In the news.
Exactly. And this is the way people are spreading political messages, messages about Votoramas.
An aggressive push from Mark Zuckerberg. You're taking that somewhere else. Up next on a program, a Thursday payrolls report.
What if we're transitioning now to a point where the labor markets are becoming a source of disinflationary pressure? And the reason that could be is because the stock of unemployed people continues to grow.
Up next on a program, Aditya Bave of Bank of America. His number for Thursday morning in the 90s. That conversation up next.
case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting this type. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years, and how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All-time highs into Monday. Equity futures, the rally continues. This quarter has been an absolute blur. Where's it all gone? Equity futures this morning up by 0.4% as we close out Q2 and the month of June. Under surveillance this morning, a Thursday payrolls report.
What if we're transitioning now to a point where the labor markets are becoming a source of disinflationary pressure? And the reason that could be is because the stock of unemployed people continues to grow. The markets, I think, are still looking for a smoking gun. And, you know, to me, that could be a negative payroll print at some point over the next few months. And when that happens, I think the markets will begin to price in more rate cuts.
Here's the latest this morning. A shortened but busy week of economic data ahead, including ADP, JOLTS, and the June jobs report. Aditya Bave of Bank of America writing the following. We expect June non-farm payrolls to come in at 95,000, lower than the consensus expectations of around 120. Aditya joins us now for more. Aditya, good morning. Good to see you.
Good morning. Thanks for having me.
So we've got lots of questions. You're looking for something like 95, but then no rate cuts for 2025.
Correct.
Lisa's got the Fed questions. I'll stick to the data. 95. Is that a bad 95 or just 95 and get used to it?
So the first thing I'd do is focus on the unemployment rate. I think that's more important than non-farm payrolls because payrolls are affected by both supply and demand, and the Fed has been pretty explicit about this. But with the unemployment rate, we think it'll land at around 4.3%. In May, it was 4.24, so that's fine. On payrolls, we think it's a combination of some idiosyncratic stuff around the timing of Memorial Day and how that affects leisure and hospitality hiring in May versus June. So basically, we expect some payback, but also structural issues, right? So continuing claims were quite elevated in the survey week for June.
Well, combine those two data points. Don't they paint a picture of deterioration in the labor market?
Softening, yes. Outright deterioration, I think we'd worry about that more when the unemployment rate goes above 4.5.
So John and I had the same question. We read your report, we saw your call for the Fed, no rate cuts, and we both said, square the circle. How can you possibly have a deteriorating labor backdrop, albeit not necessarily weak, and a Fed that remains on the sidelines without any real inflation pressure, as we've just seen in core PCE?
So that last part is what I would question. I think there is some inflation pressure. We've been stuck at 2.7% for the last year on core PCE inflation. In May of 2024, the core PCE was 2.67%. Now it's 2.68%. The excuse last May was that housing inflation was going to come down, and that was going to bring the core back towards 2%. Well, that's actually happened. We've gone from 5.5% to 4% on housing, but everything else has picked up, particularly goods. right? So we're not actually making progress on inflation even before you see the bulk of the tariff impact.
So what are you seeing right now that Mary Daly, Jerome Powell, and so many others aren't, where they're even signaling that September is the time that they're going to cut rates and it is fully priced in markets? What are you seeing that you think will surprise them into holding?
So I think September is live in the sense that it's an option, and that's the way they're setting it up, because they're concerned about how the labor market will evolve over the next 3 months. And indeed, if the labor data are super weak over the next few months, if we get to 4.5% on the unemployment rate, I think it's completely reasonable for them to cut in September. The problem is if we don't, then you're looking at potentially 3% core PCE with a still relatively healthy labor market, and then I think it gets a lot harder to cut. And when you get into the fall, you're talking about fiscal stimulus kicking in, we're getting past peak tariff uncertainty, and the economy could pick back up again.
To John's point earlier, how important is it for the Fed to understand not just who's eating the tariffs, but the tariff rates? And we might not get that by September for all these countries.
Presumably, we'll have a lot more clarity after the 9th of July, but you're right. I mean, things could still go back and forth.
How are you drawing a conclusion right here, right now, about who is going to shoulder the tariffs? We've had 2 different types of guests come on this program. I've read from Goldman Sachs, who says it's going to be the US consumer, the US companies. We've seen from other companies, including Federated and Steve Orth, who thinks it's going to be the exporter. It's going to come from the international players that have to absorb it and take it on margin. Have you seen anything in the data right now that convinces you one way or the other?
So I would start with the idea that back in 2017-18, FX actually ate most of the shock, right? So the renminbi adjusted against the dollar, and so it was neither the exporter nor the importer nor the consumer that was paying it. That hasn't happened this time around, so someone's got to pay it. And it's probably going to be a mix. If you look at import prices, they do suggest that it's the U.S. importer and the consumer will have to bear a significant burden of the tariff.
This is the ultimate question then. Is the consumer in a position to bear the ultimate cost of the tariff? Are they in a position to go back to their employer and ask for a wage increase? And that's where the pushback is at the moment. And we hear it from economist after economist. The tightness in the labor market just isn't there. They're not able to go there and ask for those higher wages. They won't be able to back this up. And therefore, you shouldn't worry about inflation getting out of control. Why doesn't that convince you?
Because the saving rate has actually increased quite significantly. So the trough of the saving rate back in 2022 was 2%. Now it's 4.5%. So in theory, if you just take that literally, that means that we have room to absorb about a 2.5 percentage point inflation shock. Nobody's talking about that big of an impact to consumer spending, right? We're talking about inflation rising by a few tenths, maybe several tenths. And I think, again, in theory at least, that could be eaten by the saving rate.
And this is why the debate continues for the summer.
Because some people say the savings rate, you can look at just the fact that a lot of consumers are under leveraged and they could add some more with respect to credit card bills. I just wonder whether it just ends up being company specific. Nike was able to pass along more of the prices. General Mills, turns out Lucky Charms isn't as popular for breakfast anymore as it was when I was a kid. So it's sort of this company by company, who has the pricing power to actually carry it through?
Not a tariff story though, right?
Well, it's both.
The cereal story, I'm talking.
That's a Maha story. Make America healthy again.
Yes, but it's also, I don't know what exactly it is. My kids don't even like it.
You've seen company after company, they're going to take out the artificial dyes.
Yeah, although I can't imagine Skittles without artificial dyes. Like, what do they look like? Just sort of like vague.
You can use beetroot extract. You can use beetroot extract. You don't need to use red 40.
I know what you think.
Is it RFK making America healthy again? Is that what you said?
Well, yeah, I think he wants to be the chief nutritionist.
There you go. We're seeing that change. Aditya, it's good to see you. Thanks for dropping by. Not going to ask you about that, don't worry. The second hour of Bloomberg Surveillance is just around the corner. Live from New York City, you're watching Bloomberg TV.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
I think that there is a structural decline in the US because there are genuine questions about the reliability of the institutions.
Base case, actually very in line with what the Fed has said, is a slowdown in growth below potential, but still positive, and slightly higher inflation.
There's a little bit of almost an over-optimism that rate cuts are coming imminently.
The next 6 to 9 months, I don't think rates are going to be dramatically lower.
We were expecting, okay, the noise is going to quiet out through the summer, and now I'm not so sure.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
What a rally through Q2. It's the final trading day of the second quarter, and so far in Q2, we're higher by 10% on the S&P 500. Your scores this morning look like this on the S&P. Equity futures up again by 0.4%, building on a 2-day winning streak on a benchmark stateside. On the Nasdaq 100, higher by 0.6%. Your week ahead shaping up as follows. Full of economic data, the big one on Thursday. Payrolls Thursday before the July 4th holiday. And then, before we get to all of that on Tuesday, we hear from Chairman Powell at the Sintra Forum for the European Central Bank, and Chairman Powell is not looking to cut rates anytime soon.
And frankly, he's the difference between the bulls and the bears right now. A lot of people saying that if the Fed does cut rates for the right reason, which is that inflation's coming down, but the market, the economy isn't falling off a cliff, you end up with a rally that's even more significant than what we've seen, taking stocks back to an all-time high. If they stay put, like we just heard from Adichie Bahave, some people think that maybe some of the froth comes off the top, given the fact that valuations will really get challenged.
Before he sets policy, he's got to work out what policy is elsewhere. July 4th for taxes, July 9th for trade, and as we've said repeatedly already this morning, both those self-imposed deadlines might slide.
They might slide, and the president himself has said it might be a few days late when it comes to the One Big Beautiful Bill. When it comes to the trade agreement, already we see from a statement from Canada that they already have a new deadline, July 21st. So it really depends what country you're coming from, what deadline you're going to get when it comes to trade negotiations. When it comes to the One Big Beautiful Bill, today's important. Senate Majority Leader John Thune's bringing everyone back at 9 o'clock. Anyone can have an amendment to your vote-a-rama. And basically, this could be hours in the making. And he's really doing all the dirty work behind the scenes. He has a number of senators he needs to shore up, basically dealing with 3 factions: the fiscal hawks, those that want to see more benefits for Medicaid and healthcare benefits, and those that are saying you're going too far on the renewables. We need to keep them. If they're were able to get this over the finish line in the Senate, and that might take some time. Does the House just capitulate and accept this? That's a big question.
The pressure's coming from within the Republican Party. It's not coming from the bond market right now. And Lisa pointed that out in the last hour. 10-year bond yields at the moment around 4.25. And it's not like this has just happened over a few days. This is 3 weeks now of lower bond yields. And last week down another 10 basis points.
Yeah, this is right now you're seeing yields get back down to places that we haven't seen since February after the biggest rally in bonds going back a couple of months. There's a real question here. Have people just stopped caring? Have people looked at the dynamics and seen inflation coming in, even with some sort of risk premium? Or is there just a great degree of complacency at a time when you have the Committee for Responsible Federal Budget coming out and saying it's going to increase the deficit by $3.9 trillion over the next 10 years? I'm not sure what to make of this, except that maybe supply isn't what's driving bonds right now.
I think it's fair to say that the Treasury Secretary, Scott Bessent, might be happy this morning with this outcome. He's going to join us later on this morning, 9:40 Eastern Time. Look out for that conversation right here on Bloomberg TV, a conversation with the Treasury Secretary, Scott Bessent, at 9:40. That's coming up later. Coming up this hour, we'll catch up with Stuart Kaiser of Citi, with stocks notching a new record high. Angelo Zeno of CFRA, with NVIDIA approaching a $4 trillion market cap, and Kurt Ryman of UPS with President Trump's big, beautiful bill stuck in Senate purgatory. We begin this hour with stocks higher after the S&P 500 posted its first record high since February. Stuart Kaiser of Citi writing valuation, positioning, sentiment and risks are very similar to January as investors grow comfortable with known risks. Stuart joins us now for more. Stu, good morning.
Good morning.
Compare now to back then. Are things better now than they were back then?
Better. It's a loaded question. I would say better in the sense that the risks are known, and once the market kind of knows risk, they can deal with it. But I would say the risk to the economy, the risks from trade are, I would say, worse than they are in January to some degree as well. So I think the headwinds for the economy are probably a little bit worse right now. Market expectations and market understanding of those risks probably better than it was back then.
So you think that right now the market is fairly pricing some of the risks that come from a weakening economy and potentially trade deals that do increase tariffs between 10 and 25%, as Kellyanne Shaw said?
I mean, you'd hope the market is factoring that sort of level of tariffs into the math. I think before you just said good news is good news, right? You said if rates are lower for the right reasons, then the markets are going to rally.
You put words in my mouth, but go for it. Carry on.
No, look, I think the market's probably fairly discounting what they think a baseline for the budget is and a baseline for tariffs are. Are they fully discounting the unemployment rate, at 4.4% on Thursday, which is what our economists think? Probably not. So I don't think we're probably fully discounting the downside risk to the economy at this point.
There was a lot of uncertainty in January. You've seen that same level of uncertainty right now, these July knowns, but still a lot of unknowns on the table?
I mean, look, it's if you go back to January, you're way ahead of April, right? I mean, back in January was, Trump hasn't been inaugurated yet, and, we've got DeepSeek and things of that nature. So I do think the risks or the uncertainties right now are pretty similar to where they were in January. They're nowhere near where they were in kind of March and April. So it's been a long year, I guess. I mean, it's been a long quarter. It's, we've had clients say, hey, well, what happened in 2Q? And I mean, the list is pretty long.
Just back to January, like a full circle, because in January, we all were expecting a 10% baseline tariff and then higher, maybe 30 to 60% on China. Isn't that almost where we're going to end up with now, after we almost went through this process of, I would say, as Trump maybe would say, getting it out of his system when it comes to Liberation Day?
No, I think that's exactly right. You're kind of pricing a base case on tariffs and things like that, and on taxes as well. I mean, the market's expected those tax cuts to get extended for the whole year. What's different is you spend 3 months beating up the economy. And I think the question is, from here, is the economy, resilient enough to recover through that, or are you in the same place in January, except that you sort of bludgeoned the economy into submission to some degree?
That's a huge question. Is the bad data still ahead of us? Now, you've got to think about things super tactically. Going into something like payrolls on Thursday, are you comfortable being long into that event?
I mean, I think risks are to the downside for Thursday in particular. I think it's going to be a low-volume trading day. Our economists are at 85K payrolls with a 4.4% unemployment rate. If that number prints, I think we're lower from an equity perspective. So, tactically for that day, no, I wouldn't want to be carrying a lot of risk into that, especially ahead of a long weekend. And, Trump has a history of kind of messing up people's weekends. So, you've got those two things going on. Big picture, yeah, I mean, we're comfortable being long U.S. equity risk. We do it through a more high-quality lens, just given these uncertainty. So yeah, very tactically, I'd be cautious around that payroll sprint. Next couple of weeks, probably okay being long equities in that environment.
How scary is it to be bearish right now? And I say this, how scary is it to come out with something that isn't just, ride the melt up? That is the biggest risk, pain trade. This idea that bears have gotten blown up time and time and time again. People who looked at the headlines and said, ooh, this bad. Not so much. Turns out it isn't so bad. I mean, how much is that scaring people away from tactically turning negative?
I think it's a great question. If you were short in like early April, for instance, I mean, you just got destroyed on the way up. And consistently speaking, the tail risks have been trimmed off and the worst cases have been walked back. And if you've been short, that stuff has really worked against you, right? Like, I think for a short or a bear to be happy these days, they really have to be betting on U.S. economic data weakening or a significant re-escalation in the China-U.S. Trade war situation. So I think you need Trump to come out and say, they're not negotiating in good faith, we're going back to 100%. I think you need something to that degree to turn tariffs from a buy the dip opportunity into I need to sell.
What about on the flip side? What do we need to see on the economic data front that would cause the bulls to get even more bullish, for there to be a more fully broadening out in the rally that a lot of people have been waiting for, to say, okay, now we're actually seeing something that's sustainable?
I think it's exactly what you described earlier, which is you get a couple of rate cuts, not because the economy is slowing, but because inflation's coming off and the economy is kind of moving along in this late cycle kind of sideways fashion. And then you're doing $1 trillion of buybacks and you've got systematic buying and you've got foreign investors re-engaging in the U.S. So there is a story there. And it's just what you described. It's the economy kind of holds in, and we get a couple sort of supportive rate cuts behind that, with Trump promising more next year, and then the market, I think, can rally pretty well into that environment. So it's the economy at this point, I think.
Could you just clarify your bullish posture with a little bit more detail? I assume it's not just get long Mag 7, load up on big tech. Is it something a little bit more nuanced?
Yeah, I mean, I think it's quality across the board, so it's not just tech. We actually like semiconductors as a quote-unquote catch-up trade. I know it doesn't feel like a catch-up trade, but it is an area that's actually underperformed in the analog semi space. So not just your NVIDIAs and your Broadcoms like the other folks. So yeah, it's kind of quality across the board. Mag 7 falls into that category, so it kind of gets swept up in there. We've generally liked large cap growth, as you know, for most of the year. We kind of backed off on that a little bit when rates started to dislocate to the upside. So we're kind of in a higher quality kind of, rate insensitive, stock right now.
There was another consensus sector long coming into 25, and I don't hear much about it anymore, but it was the banks. Everyone coming into 25, everyone sat in your seat. What are you long? We love the financials. What do you like? We love the banks. Where are the banks now?
Yeah, I mean, we would probably would have fallen into that category ourselves. We've actually seen quite a bit of demand for regionals and smaller cap banks for the last couple of weeks. And I think that is folks that like the banking sector, think the economy is going to kind of pick up a little bit and are looking for this laggard as we get it to all-time highs. Look, you've got earnings coming up. You had the SLR. You're going to get potentially CCAR, later this week into next week. It's just going to remind people that financial is the second biggest buyback sector in the market as well. So you have a flows dynamic, you have a regulatory dynamic, you have growth holding in, you potentially get a steepening yield curve. You can quickly talk yourself into this being an environment that's very good for banks. I think the question is, within banks, what do you own? Are you hiding in those big, high-quality, large-cap folks, or are you willing to kind of go down cap spectrum, play more of an M&A theme, play more of a small-cap catch-up theme? I think we'd probably, at this point, still be comfortable in that larger cap, higher quality. But, it'd be dishonest for me to say that clients are not trying to engage in those smaller cap stocks right now.
To that exact point, I was actually looking at a series of statistics that Dan Curtis of Bloomberg puts out on a daily basis, and he was talking about how the volume of IPOs that have started trading so far this year is actually the greatest going back to 2021, 2022. Are we going to see an ongoing momentum in that space that a lot of people have now written off as being a lot more subdued than initially thought at the outset of 2025?
I mean, I certainly hope so. I think the M&A cycle was just a huge part of the thesis coming into this year, that you have an administration that's maybe a little more open-minded about M&A and things of that nature. And we've seen it. Like, I would put, M&A, I would put that in what I would call institutional risk sentiment theme. Like, most retail investors are not trying to identify M&A targets, right? This is more of an institutional hedge fund trade. And when you see, like, our M&A targets basket has just been a rocket ship to the upside because, I think institutional risk sentiment has improved so much that people are willing to put money to work there. Whether it happens, I don't know. I'm sure you're going to hear in 2 weeks from most of the investment banks that the pipeline looks great, et cetera, et cetera.
What's that?
Yeah. Yes, for a couple years, right? I mean, so look, we want that trade to work because that is an institutional positive risk sentiment, markets moving higher type theme. Will we see it? I don't know. I mean, we've had a couple very successful IPOs, but you need to kind of stack those on top of each other, I think.
The C-suite's just been aggressively whipsawed over the past 6 months or so. We came into 25 and you had this really sort of proactive, confident posture in places like the World Economic Forum in Davos, Switzerland. Fast forward a few months, April, it was sit on your hands and wait.
Honestly, we should do a basket for the anti-Davos sentiment and have people trade it in January and see how well it does every single year, because pretty much American exceptionalism, Europe needs to get off its can, let's go, this whole mood. I mean, every single year without exception. And this year was no different.
Confidence of American bankers like right up here.
I mean, the highest
to start 25. And I guess all-time highs in the equity market might justify that to some extent, because here we are. Equities at all-time highs this Monday morning. Stuart Kaiser of Citi is going to be sticking with us. Futures up again by 0.4% on the S&P, with an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. Senate Majority Leader John Thune is rushing to meet President Trump's July 4th deadline to pass his massive tax and spending bill. But Thune is facing opposition from 8 Republican senators and must find a compromise. Some are pushing for deeper spending cuts, while others want more funding for health benefits and renewable energy subsidies. Meanwhile, Zohran Mamdani, the presumptive Democratic nominee for New York City mayor, says billionaires shouldn't exist. In an interview yesterday, Mamdani said it is so much money in a moment of such inequality. President Trump threatened to pull federal funding from New York City if Mamdani becomes mayor, and according to him, doesn't do the right thing. And President Trump says he found a buyer for the U.S. operations of TikTok, but won't provide details for, you guessed it, 2 weeks. Trump said it's a group of very wealthy people, but the deal will need China's approval. Trump says he expects President Xi Jinping to agree to it. That's your Bloomberg brief. John?
Talk about purgatory. This company's just sort of in this rolling 90-day extension.
Yeah. And now it's
forever, it seems.
Yeah, it's sort of, is it going to be killed? Is it going to die in the United States? Well, 2 weeks. Just wait 2 weeks, and that's sort of where we are again.
Perennial extension for TikTok. But the fact of the matter is, you got to have China on board to be willing to sell this. And that's really the problem. I don't think having the buyers that want to buy this is the issue.
Yahara, thank you. More from Yahara in about 30 minutes or so. Up next on the program, the struggle to strike a trade deal.
What I want to do is, and what I will do just sometime prior to the 9th, is we'll send a letter to all these countries. We'll send a letter and we'll say to shop in the United States, and you'll pay a 25% tariff, and we wish you a lot of luck. And that's the end of the trade deal.
Thank you for your attention to this matter.
Yeah. I love that.
Each letter.
Signed, President of the United States of America.
Up next on the program, Tyler Kendall is going to join us next to break down the situation. Going into 2 key deadlines, July 4th, July 9th, for taxes and for trade. Live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Looking to close out the quarter with equities at all-time highs, up another 0.4% on the S&P 500 on the quarter so far, higher by something like 10%, the biggest quarterly gain for the S&P 500 potentially going back more than a year. For the FX market, totally different story. Euro-dollar has had an 8% move over the quarter. Lisa, the worst quarter for the dollar against the euro back to December 22.
And I'm old enough to remember when people would point to this and say this was the end of American exceptionalism. The new trend has been this is the beginning of FX hedging desks across the United States, because ultimately this is all of the institutional investors from overseas saying, oh, the dollar might be a risk. We better get on that. It isn't necessarily coming from outright selling.
Jim Zouter of Apollo on the program just last week saying look to the earnings from the financials later on in the quarter to speak to that theme.
And that's ultimately what we saw with a number of studies over the weekend, in particular from Morgan Stanley, that looked at some of the tick data, the Treasury data that came out last week, and said you're not actually seeing outright selling. If anything, you are seeing net buying of U.S. stocks and U.S. bonds.
Euro-dollar, 117.25. Out of Savannah's this morning, it's the struggle to strike a trade deal.
What I want to do is, and what I will do just sometime prior to the 9th, is we'll send a letter to all these countries. There's 200 countries. You can't talk to all of them. We'll send a letter and we'll say we would consider it a great honor, and this is what you'll have to do to shop in the United States. We're like a department store, to shop in the United States, and you'll pay a 25% tariff, and we wish you a lot of luck. And that's the end of the trade deal.
It's the latest this morning. Trade partners lining up to strike a deal before President Trump's July 9th tariff deadline. The White House saying agreements with as many as a dozen countries are expected by next Tuesday. Joining us now to discuss is Bloomberg's Tyler Kendall. Tyler, not all countries will be treated quite the same, so who's at the front of the line going into next week?
Yeah, hey, John. Well, a person familiar tells Bloomberg News that the U.S. actually is nearing some sort of agreement. We would expect these to be frameworks, not fully fleshed out deals with a few different economies. That includes Taiwan and Indonesia. They also say that pacts are possible before July 9th with Vietnam and South Korea. Now, that's not necessarily surprising, since we know that this administration has long prioritized those economies that are geographically close to China. Now, we'll have to see actually how this does come into effect, as the administration has said. On one hand, we could expect a handful of deals before July 9th, but then as you heard President Trump there, he has long toyed with this idea of setting an effective tariff rate and letter set to our trading partners, and perhaps July 9th really could serve as the deadline for him to actually do so. It was interesting to hear the former Trump trade official Kellyanne Shaw say earlier on this program that she is expecting perpetual negotiations under this administration. And I will point out that it's been really fascinating to see how sector-specific tariffs have also made their way into these conversations in such a meaningful way, considering that our original understanding was that these levies enacted under Section 232 on the grounds of national security concerns were not going to be up for negotiation. But then, John, you had President Trump over the weekend threatening to keep auto tariffs on Japan at 25% amid a roadblock in those talks, giving us some insight into how this administration is playing with a lot of different factors here as they try to work towards some sort of progress on trade deals.
Tyler Kendall down in Washington, D.C. Tyler, thank you. Stuart Kaiser City still back with us. Stu, we've had a few people say that the outcome of July 4th and that deadline might inform what happens on July 9th. Do you see it that way?
Not necessarily. I feel like those are kind of independent, from one another. What you get on July 4th may reference tariff revenues as a way to sort of justify a larger deficit. But I don't know. I feel like you're negotiating with July 4th is within the GOP negotiation. This other is negotiation with other countries. I think they're relatively separate, though. I do think, frankly, expectations are pretty high for both at this point. I think markets are assuming a budget deal will get passed with a pretty high likelihood. I think they're assuming all the tax cuts will be extended. And on the tariffs, I think they're assuming that you'll have the vast majority of these deadlines, either an agreement reached or rolled out because of good faith negotiations, and you'll probably get one or two countries that are used as an example to kind of prove that Trump is still serious about that. But I think both of those outcomes are probably net positive for equity markets.
Expectations are high that it gets done, but are they high enough that it gets done on July 4th and July 9th?
Yeah, on July, I think most people are assuming July 4th, to your point, may get pushed a bit, but it's not going to get pushed into August, right? This is going to be something where they have a framework of the deal and they're sort of moving chairs around on the Titanic, as you would say.
When you talk about deals getting done, do you mean every single country but China?
It's a great question because you could argue that a lot of people assumed it would be negotiate with our trading allies first and then everybody negotiates with China as a bloc. He's kind of thrown that upside down, right? He's kind of done an end around and negotiated with China initially, which you might argue undercuts the leverage of countries like India and Europe in their negotiations with the U.S. So I think initially the assumption was allies first and then China, but it's a little hard to figure it out right now because that order has kind of been like thrown up in the air a little bit.
Tyler brought up a good point, sectoral tariffs. We haven't seen them yet, and these will have what many analysts say and lawyers say a lot better and solid legal footing. Are you concerned what that could mean from an equity perspective?
Yeah, definitely. Depending what sectors you're targeting, obviously, semiconductor tariffs are going to be an issue. Potentially stuff in the healthcare sector, I think can be a big issue as well. So, yes, but right, these get rumored, the markets move, and then they get kind of rolled back. So, yes, we're definitely concerned about it. Not necessarily because they're more legally defensible, because I don't think most investors have any idea what the legal grounds for a lot of this stuff are. Anyway, but yeah, I think to your point, the good part about the sectoral tariffs though is it's much easier to trade, because you can trade the sector in those stocks directly. These big, broad-based, across-the-board tariffs, it's basically just a beta 1 sell market. It's not, it's not as nuanced, it's not as specific and targeted. So I actually would prefer to have to trade sectoral tariffs than bigger, broader-based ones.
Are we understanding the margin compression that comes with tariffs that can't be fully passed along in terms of the price increases to consumers?
Potentially, but the dollar's weaker, so those earnings are going to repatriate at a higher rate, so we're all good. Look, I don't think we really know what's going to happen with margins on a go-forward basis. Nike's call last week, it actually sounded like they were going to basically eat margin a little bit, or maybe they were going to try to pass on cost. It was a little hard to determine based on their forecast which way they were going to go. I think a lot of these companies don't know themselves because they don't know what the tariff is going to be on Vietnam vis-a-vis Taiwan, vis-a-vis Korea. So, your supply chain is also kind of in flux, I think, for a lot of these companies. So I don't think there's a clear understanding yet of what the impact is going to be on margins, which is why 2Q earnings should be so important, right? These companies were given a pass in 1Q. Will they be given a pass again if they don't provide that level of detail?
If you're long stocks, can we just finish with this question? What is the best outcome on July 9th? Extend and pretend or 10% and move on? Extend and pretend or 10% and move on? What's the best outcome? I mean,
if the move on was for sure, then you'd want the 10% and move on, right? But you could get 10% and move on, except we're going to come back to it in a couple weeks. And I think that would be the bigger risk. I think what markets are probably girded up for at this point is, I don't know, 70 to 80% of these countries, either a framework is in place, negotiations are progressing well, we're going to push it out. These other two are, those are the bad apples. We'll have to deal with those later. So in that sense, I think the more likely outcome is that if you could tell us for sure 10% across the board, 30 to 40% on China, and we're done, that is the best outcome, but I think it's probably the less likely of the two.
It's a small detail buried in the headlines of Q2, but if you go back to April 2nd, initially the market thought it was 10% and done, and we started to rally. And then the table got held up in the Rose Garden, you remember? With all the big numbers, you were there. All these massive numbers in this market went south.
The initial story, I believe in the Wall Street Journal, everything 10% and it's fine, and then people started saying, like, that's not 10%, that's 30-something percent.
Handing out the handouts, and I was like, whoa, this isn't 10%. Oh my God, Europe, Switzerland. John goes, tweet that right now.
Equities right now, futures positive, 0.5%. Up next on the program, Angelo Zeno of CFRA on NVIDIA, Danny Berger on HP.
of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The moves through Q2, phenomenal. Equities right now positive by 0.5% on the S&P. Child's play, 10% higher on the quarter. Off the lows, up by 23.89%. That's the rally off the low on the S&P 500, off the low of April 8th. On the Nasdaq 100, that rally off the lows of the quarter is more than 30%. Nasdaq 100 futures this morning positive by 0.65. With 2 hours until the opening bell, let's get you some morning moves and crossover to Danny Berger. Hey, Danny.
Hey, John, a little bit of deal news for you. HPE has been pursuing this takeover of Juniper Network. It had faced a lawsuit by the DOJ. As of the close on Friday, they have settled that lawsuit, clearing the way for this takeover to happen. HPE just needs to sell off a few of its assets. So those shares for HP up 10.5%. Juniper Networks, those shares up 8.4%. Also, some breaking news in the last hour. Moderna is successfully seeing one of its trials for an mRNA flu vaccine. That means I would be able to offer a combo vaccine of both COVID and flu. Now, because the uptake of COVID vaccines has been less in recent years than flu, it also means that they would, in general, sell more COVID vaccines. So those shares of Moderna up 5.4%. Finally, rounding things off this morning with just some of the banks, some outperformance this morning. Wells, Goldman, Bank of America up as much as 2.8% in the case of Goldman Sachs. No surprise, but they passed their stress test. We learned that Friday after the close. In general, the thought is that helps pave the way for more dividends, more buybacks. So the banks rallying this morning, John.
Danny, thank you. More on the banks in about 45 minutes' time. More from Danny as well in the next hour. On our radar this morning, Senate Majority Leader John Thune is rushing to meet President Trump's July 4th deadline to pass the tax and spending bill. Thune will have to appease 8 GOP holdouts who still have concerns.
The numbers are tight. He basically already lost 2 senators. When you look at Senator Tillis and you look at Ron Paul, J.D. Vance is going to have to come in, at least for his support. So he can only lose 1 more. And he's dealing with different groups of factions. We've been talking about this since the onset of the bill. It's a problem in the House. Now it's a problem in the Senate. Say you decide that you're going to be a little bit more friendlier when it comes to, say, the Renewable Caucus or those that care about Medicaid benefits. Well, what's going to happen to those fiscal hawks that are saying we are spending too much? And even if the Senate is able to do this, then the House has to deal with it. And there are going to be some problems with the House. Just take a look at Chip Roy's Twitter handle throughout the entire weekend, and you can see the Freedom Caucus is not happy what's going on the upper chamber.
You asked earlier, is it theater or is it actually a fissure in the Republican Party? And I don't know that there is such a distinction between the two because each person wants to get something. You talked about 8 members of Senate. Well, half of them want more cuts to Medicaid, and half of them want fewer cuts to Medicaid. Everybody wants some sort of reconciliation to their personal need. You just have to wonder whether markets are fully appreciating what's going to end up being in here and what kind of offsets are going to be there. This ultimately will be the debate once the market gets its hands on it.
Well, Tillis isn't running again.
Exactly.
Good morning, Mr. Senator, because I know you watch the program. He's not running again, and he might burn the whole place down on the way out.
So basically, now that he has been freed almost of saying, I am not running again, he is giving some fiery speeches, and this could be just the beginning for him. And potentially, and the Wall Street Journal editorial board talks about this morning, potentially what Trump did is kind of broke up the Senate in this way and opened up a seat very early on for the Democrats to really start looking at when it comes to North Carolina.
Let's talk about the substance and another unhappy person, Elon Musk, the Tesla CEO and ex-First Buddy, slamming the Senate's version of Trump's bill, saying cuts to EV and other clean energy credits are, quote, incredibly destructive. Musk saying the bill will destroy millions of jobs.
And this comes for a personal reason, obviously. His company is one of the beneficiaries of some of these tax credits. It also points to another fissure among Republicans. Tom Tillis, you mentioned him before. He also would like to see some of these green energy tax cuts or tax subsidies put in there simply because they have actually bolstered some of the red states in terms of manufacturing and in terms of production.
Elon Musk is not the only one. You have a bunch of unions coming out representing construction workers, one saying last night this is equivalent of terminating more than 1,000 Keystone XL pipeline projects. You have the U.S. Chamber of Commerce coming out and saying this is a strong pro-growth bill, but there's always a but. Taxing energy production is never good policy, whether oil and gas or in this case renewables. Electricity demand is set to be enormous growth, and this tax will increase prices. It should be removed. What I'm confused about is how the administration is saying we're going to go after renewables and tax this excise tax, et cetera. At the same time, we are waiting for Trump to sign an executive order to talk about the insatiable energy that is going to be needed for AI demand. So how do you really claim you're for both? It's very confusing.
Some of the pushback there for the tax bill on monetary policy, we have had even more pushback than that, particularly from the president. President Trump saying he has 3 names in mind for his Fed chair pick. Trump was asked specifically about the former Fed governor, Kevin Walsh, but said the following. He said, quote, I don't know that it's going to be him, but he wouldn't be doing what Powell is doing.
Well, Kevin Walsh is the person who everyone points to as saying, really? He's not exactly dovish. Why would you want him in it? This just goes to build on the idea of what the timeline would be to put in a potential candidate to be the next Fed chair who could act as a shadow Fed chair. Scott Bessent on Friday was talking about this, and he said there are 2 Fed seats that come up next year. You've got in January Adriana Kugler, and then you have later on in May, you have Fed Chair Jay Powell. Ostensibly in January, President Trump could put somebody in Adriana Kugler's seat who would then serve as Fed chair when Jay Powell would end his term in May, which means that it could be the October or November or even September timeframe.
The shadow chair might be on the inside.
Exactly, which is sort of interesting.
Fun and games.
Exactly.
And lots of dissent.
Also, we need to know, though, is Jay Powell going to keep his seat?
Right.
He will not be chairman, but he can stay on the board, and he might just want to lurk.
We'll hear from the Treasury Secretary later on this morning about lurking on the FOMC and what he thinks of that. I think the Treasury Secretary's basically acknowledged that the Fed chair could sit there and keep his governor seat.
Yeah, and that ultimately go for it. I think it ends in 2028. I believe so, and that would be, he hasn't confirmed, though, whether he wants to do that. I guess we'll have to see. He says his head is squarely focused on what's in front of him.
Of course. Secretary Bessent, 9:40 Eastern Time on Bloomberg TV. Look out for a conversation on that and a whole lot more. Let's turn back to tech. Chip stocks up nearly 30% in the second quarter, led by Broadcom, ARM, and Microchip Technology. The rally set to continue, NVIDIA surpassing Microsoft on its way to a fresh $4 trillion market cap. Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, good morning.
Morning.
DeepSeek, it's all over. It's terrible. Everything's going to blow up. And here we are several months later. What changed?
Well, what changed is there are new use cases that have emerged, and coding assistant is a great example of a market that wasn't there, especially, to the extent that companies like Cursor and now Google launching their own coding assistant. That market could be $50 billion plus. That market is all driven by generative AI. So people talk about search getting disrupted. There are other pockets within software that are getting disrupted by generative AI, and that's why that reasoning aspect of what generative AI is doing with regards to your LLM being able to run any sort of browser session, any sort of code at runtime, that's huge, and that's what's driving the compute right now.
This is important, and it's fundamental, and it comes at a time where we're talking about new record highs for the S&P on the heels of the likes of NVIDIA and Microsoft, up 45% and 32% respectively, just in the past quarter. I'm just wondering, from your perspective, whether this wasn't known and whether this is a new development enough to generate the same kind of return on investment, the same kind of cash flow that would justify this type of revaluation.
Yeah, I mean, what people underestimated was that there is ROI in terms of the compute being spent, And right now you are starting to see that ROI. The other is competition for the likes of NVIDIA was the hyperscalers, your Microsoft, your Meta. Well, guess what? Their chip efforts have taken back in terms of their ability to make a chip that's comparable to NVIDIA. And that's why a company like NVIDIA and Broadcom are getting bid up, because the hyperscaler chip efforts are just not materializing the way everyone expected.
The rally off the low for NVIDIA, 67% off the lows of early April.
You can't bet against this trend, and that's what people keep learning. And it's so hard for people who want to be bearish and say, oh, it's a bubble, but it's not. Because guess what? They just came out with this new thing.